So hello all my dear students of CA final direct tax for May 23 of South India. I hope you all are doing good and you all are studying well for your coming exams. So today we are going to discuss all the 25 ICAI case scenarios relevant for your May 23 and November 23 exams in detail. And in the meanwhile, when we'll be discussing the 25 case scenarios, we'll be almost covering more than 100 concepts relevant for the income tax law. And more than 50% of the income tax important concepts will be covered in this 25 MCQ scenarios. So I request you all to study all of them properly because these are extremely important and one of the best made MCQs ever in the entire country, as I have told you again and again. You don't have to go here and there to find out MCQ. You only have to follow the MCQs which has been released by the ICAI. These are the best ones. You cannot compete these MCQs with any other professor's MCQ. Okay, everybody has to rely on this. These are one of the best quality MCQs that you would ever get. So here my objective is to discuss the reasoning of each and every MCQs which are over here, and I will be discussing the reasoning of each and every MCQs. Irrespective of whether you have learned earlier or not, whether you have gone through the MCQs or not, you have to see this video at least 2 to 3 times to the extent it is possible. Once now at least and once before the examination. Without wasting any further time, let's discuss the first MCQ that is based on the provisions of 44AA, 44AB, 44AD, 44ADA, 139(1), so on and so forth. So these are multiple concepts which are going to be covered in this first MCQ. Okay. So let's start with the first question. I assume that you will be going through the question first and I'll be discussing all the answers over here. I'll not be reading the entire scenario in front of you. That will be wasting a lot of time over here. Okay. So the first question is, which of the following individuals are eligible to declare income on presumptive basis under the provisions of the Income Tax Act? So we need to answer that. Who are the eligible persons who are eligible to declare their income on presumptive basis? So let's see that. First of all, Arvind is doing business. Is Arvind eligible? The answer is yes. Because Arvind's turnover is less than what? 2 crore rupees. He is eligible to do what? 44AD. Arjun is also doing business. His turnover is also less than 2 crore. He can also go for 44AD. Anand cannot go because Anand's turnover is more than 2 crore and it is not possible for Anand to go for 44AD. Akash is into an interior decorator business, which is a specified profession which is covered under 44ADA, and his gross receipt is also less than 50 lakhs. So Akash can also go for what? The presumptive income provisions. So out of 4, 3 people can go. Anand cannot go for the presumptive income provision, and that is the answer of this particular question. Okay. Let's move on to the second one. Which of the following individuals have to mandatorily get their books of accounts audited under section 44AB for 23-24? Let's see. Now, Arvind is not required to get the books of accounts audited because his turnover is less than 2 crore rupees. Arjun is also not eligible because he is also going for presumptive income. Arvind is going for presumptive income. He will not get his books of accounts audited. Arjun will also not get his books of accounts audited. Let's talk about Anand. Anand will also not get his books of accounts audited because for Anand the tax audit limit is 10 crores. Why? Because in case of Anand, the aggregate cash receipt and the aggregate cash payment does not exceed 5% of total receipts and total payments. So do you remember that if the aggregate cash receipts and cash payment does not exceed 5% of your total payments and total receipts, then for you the tax audit limit in case of business it is 10 crore rupees. And therefore, Mr. Anand is fulfilling that limit of 5%. And therefore, for him, the limit is 10 crore. He is also not liable for audit. Okay. And Mr. Akash is also not liable for audit. So, none of them are liable for audit. Why Akash is not liable? Because Akash is also following presumptive income. So, Akash is following presumptive income. Arvind is following presumptive income. Arjun is following presumptive income. And Anand is fulfilling the 5% bracket. For him, the turnover limit is 10 crore. So, none of them are eligible for what? Tax audit. None of them are liable for audit. Okay. This is what this question wants to say. Next question. What is the amount of profits and gains of business chargeable to tax in the hands of Mr. Arvind, Mr. Arjun, Mr. Anand? Assuming that they wish to make maximum tax savings without getting their books of accounts audited. So, they want to have maximum tax savings, but they don't want to get into the lane of what? Getting the books of accounts audited. So, in that case, what will happen? So, let's see. So, without audit, what will be the answer? For Arvind, it is very simple. The turnover of Arvind is 95 lakhs, out of which 85 lakhs is received before the due date by RTGS and NEFT. So on that portion of turnover, the deemed income will be 6%. And the remaining 10 lakhs, the deemed income will be 8%. Total turnover is 95 lakhs. 85 lakhs is received before due date and by electronic mode, by RTGS and NEFT. So 85 lakhs, 6%. And remaining 10 lakhs, how much? 8%. So for Arvind, the answer will come to 5.9 lakhs. You can compute that, okay? For Arjun also, you have to do the same thing. The total turnover of Arjun is 1.8 crore. Out of that, 1.65 crore is received on time by the electronic mode. So on 1.65 crore, the deemed income will be 6%. And on remaining 15 lakhs, the deemed income will be 8%. Remaining 15 lakhs, deemed income will be 8%. Check it, please. So the answer for the second person will come to how much? It will come to 11.1 lakhs. Now the third person is Anand. For Anand, there is no limit. There is no presumptive income applicable. Anand has to show the profit as actual profit 30 lakhs only. For Anand, there is no presumptive income. Anand's turnover is beyond the presumptive income limit of 2 crore. So for Anand, the profit would be 30 lakhs only, irrespective of what he does. So for Anand, it is 30 lakhs. You can check. Okay. So these are the three answers which are for Arvind, Arjun and Anand. Okay. Let's move on to the fourth MCQ. Would your answer change? Would your answer to MCQ number 1.3, that is profits and gains of business chargeable to tax in the hands of Mr. Arvind, Mr. Arjun and Mr. Anand undergo a change if they decide to get their books of accounts audited? Now let's see. If they want to get their books of accounts audited, will their answer change? Now let's see if their answer will change or not. Let's see that. The Arvind's presumptive income was 5.9 lakhs and actual profit is also 5.9 lakhs. So Arvind's answer will not change because presumptive is also 5.9 lakhs, actual is also 5.9 lakhs. It doesn't make sense to do an audit. Okay. Why to get unnecessarily books of accounts audited? Yes, but Arjun's answer will change. Why? Because for Arjun, the presumptive income was 11.1 lakhs, but here the profit is, actual profit is 10.5 lakhs. So for him, it is a benefit to get the books of accounts audited. So Arjun's answer will change. Even Anand's answer will not change. For Anand, the audit is not applicable only. For Anand, the audit limit is 10 crore rupees. So Anand is not liable to audit only. Therefore, only Arjun's answer will change. Anand and Arvind's answer will not change. You can see that. Okay. Arjun's answer will undergo change because for Arjun, there is a benefit to go from 11.1 lakh to 10.5 lakhs. And Arvind and Anand, there is no benefit over here. Okay. And one last question in this first MCQ. What is the due date of filing of return of Mr. Arvind, Mr. Arjun, Mr. Anand and Mr. Akash for AY 23-24? If they wish to make maximum tax saving, so they want to make maximum tax saving. Who can make maximum tax saving by doing audit? Only Arjun can do maximum tax saving by doing audit. So let Arjun do audit, let others not do audit. There is no sense for Arvind to do audit because even if he does audit, it will remain 5.9 lakhs. There is audit no applicable for what? Anand. For Anand, there is no audit applicable. But for Arjun, it makes sense to do audit because it will reduce the profit. For Akash also, it doesn't make sense to do audit because for Akash, the turnover is 48 lakhs. The 50% of that will come to 24 lakhs. And if he does audit, that profit will be 24.75 lakhs. So why he will do audit unnecessarily doesn't make sense because his actual profits are more than deemed profits. So for Akash also, there is no need to do audit. So only Arvind is going to do, only Arjun is going to do audit. And if Arjun is going to do audit, for him, the due date of filing of return will be 31st October. And for rest of them, the due date of filing of return will be 31st July. Okay. So this is what the first MCQ is all about. And this is how we are going to go about for the entire booklet. Now you can go through it once and then we'll move ahead with the second one. Okay. So now let's move on to the second MCQ, which is one of the beautiful MCQs of this particular entire booklet, which is based on your MCQ regarding 9B and 45.4. The concepts which are covered over here is section 9B and 45.4. Okay. Now you have to go through the MCQ first of all and then I'll discuss the answers. The answer to the first question is, what would be the amount of taxable under 9B in the hands of XN company and YN company for AY 23-24? Now pay attention please. What is taxable in 9B? 9B is applicable in case of dissolution as well as in case of reconstitution. Now in case of 9B, when a firm gives an asset to the partner, then it is taxable in the hands of the firm. Now, what is the consideration? In that case, the consideration is the FMV on the date of transfer. Okay. And what will be the cost? The cost will be the cost of acquisition. So, in case of XN company, what is the firm giving? In case of XN company, the firm is giving one land. Which land? The firm is giving one land over here. You can see at Nagpur. What is the FMV of that land? The FMV of that land is 45 lakhs, and therefore the sale consideration of that land will be 45 lakhs. And what is the cost of acquisition? The cost of acquisition is 25.4 lakhs, and this land was purchased in 2015, so it will be a long-term land, and therefore we are supposed to compute capital gains based on that. Okay, so we have to index this 25.4 lakhs. So I am doing the indexation over here into 331, that is the indexation of 22-23 divided by indexation of 15-16. The cost will come to 33.1 lakhs, and accordingly the capital gains is how much? The capital gains is 11.9 lakhs in case of XN company. Okay. In case of YN company, there are three assets which are transferred by the firm on dissolution. Because the firm is dissolving, they have to transfer everything now. In case of YN company, they are transferring three assets, that is asset 1, asset 2, asset 3. And now, therefore, in that case, we have to compute capital gains thrice, and then we have to total it. That's it. So, the sale consideration is 62 lakhs because the FMV will be the sale consideration. The sale consideration is 59 lakhs and the sale consideration is 70 lakhs. The cost is this, all of them are long term because they are held for more than 24 months. Okay. So, you have to index all of them, you have to index all of them, you have to index all of them, and you have to compute three cost and then compare with the three sale consideration. This is the three cost, the 191 is the sale consideration. You take the difference and you will get the capital gains as 104.94. This is your capital gains. Okay, 104.94, that is 1,04,94,000 is your capital gains. So this was an easy question. Okay. Now the second one is a beautiful one. What would be the capital gain taxable under 45(4) in the hands of XN company? So in the case of XN company, we are supposed to compute the capital gains under 45(4) now. Now 9B is over, 45(4) is applicable. Now remember, 45(4) is only applicable in case of reconstitution. In case of dissolution, 45(4) is never applicable. Be very careful. Okay. So because of that, the question number 3 becomes redundant. What would be the capital gain taxable under 45(4) in case of in the hands of YN company for AY 23-24? You have to say nil. Why? Because in case of dissolution, 45(4) is not applicable only. In case of 45(4) is only applicable in case of reconstitution. Therefore, 45(4) is not applicable in case of dissolution. Therefore, the capital gains chargeable in case of YN company will be nil only. Because in case of YN company, there is no reconstitution, there is dissolution, and in case of dissolution, 45(4) is not applicable. So the answer to that question is nil. That question is redundant to us now. Now, what would be the capital gains? Coming to the second question, what would be the capital gains under section 45(4) in the hands of YN company? Sorry, in the hands of XN company for AY 23-24. Now, this is the most important question for us in this entire case scenario. Now, how to compute capital gains in case of 45(4)? There is a formula which the government has given. The capital gains is A is equal to B plus C minus D. Now, what is B? B is the money received by the partner. Okay, what is the money received by partner? The money received by partner is 15 lakhs. So, I am writing B as 15 lakhs. Okay. Now, what is C? C is the assets received by partner. Now, what is the assets received by partner? Nagpur land. So, you have to take the FMV of the assets as C. C is the FMV of the assets received by the partner. So, 45 lakhs. Okay. Till here, everything is fine. Now, what is D? Here, the real catch is D is the balance in the partner's capital account. So, we have seen above the balance in the partner's capital account is 32 lakhs. So, I am writing 32 lakhs, but this is not where the solution ends. There is one more step that you are supposed to do. That is what I have taught you in the CBDT circular number 1, 2, 3. We have done 3 circular based on 9B and 45(4). What you are supposed to do? The land which is transferred by the firm to the partner, that land is revalued first and then it is transferred. That land is revalued by how much? 19.6 lakhs. See, that land was purchased at 25.4 lakhs and it was revalued at 45 lakhs. Therefore, it was revalued at 19.6 lakhs. Therefore, there was an increase of 19.6 lakhs book profit in the firm. So, I have to add that book profit over here in the partner's capital. Now, wait. The solution is not ending. You have to add that book profit because the firm is revaluing the assets. So, revaluing the assets is increasing the profit of the firm. So, the firm is increasing the profit, is revaluing the assets by 19,60,000. At the same time, the firm is also paying income tax under 9B. On how much? On 11,90,000, the firm has paid 20% tax, long-term capital gains, right? On 11.9 lakhs, the firm has paid 20.8% tax. So on 11.9 lakhs, 20.8% tax comes to 247,520. So the total increase in profit was 1960, but the firm has paid 247,520 as income tax. Therefore, the net increase, net profit after tax was 17,12,480. But this is for all the partners taking together. So every partner should get the proportionate profit in their capital account. So you have to divide this by 4. This is the same treatment which we have done earlier. You have to divide this by 4, and therefore your profit to every partner capital account should go to the extent of 4,28,120. So 4,28,120 has to be transferred to every partner, including the retiring partner. So I have to add this 4,28,120 over here, and that is going to be my D. So my D will be how much? 36,28,120, that is 32 plus 4,28,000. Therefore, now my B plus C minus D will come to how much? 23,71,880. This will be my capital gains. But this is not my answer. This is my total capital gains. Now I have to bifurcate this into long term and short term. So how to determine that whether it is long term or short term? That we have done it in class again. That you have to determine it as long term or short term based on the remaining assets with the firm and based on the remaining assets of the firm. So what are the remaining assets of the firm? The remaining assets of the firm is land at Pune, land at Mumbai, and self-generated goodwill. So how will I determine? If the remaining assets are long term, then this is also long term. If the remaining assets are short term, then this is also short term. So out of the 3 assets, 2 assets are long term. This is long term, this is long term, and self-generated goodwill is considered to be a short term. So you have to divide your entire capital gains in this ratio. Which ratio? Is it on the basis of the FMV? No, no, no. It is not on the basis of FMV. It is on the basis of the revaluation done by the firm. So the revaluation is how much? For long-term assets, the revaluation is 35 plus 162. That is for long-term, the revaluation is 197. And for short-term, the revaluation is 70. So you have to divide your entire capital gains in the ratio of 197 is to 70. So this entire capital gains is divided into in the ratio of 197 is to 70. And the answer will come to this. And this is what the answer is all about. You can check it over here. Okay. So whatever the capital gains comes, you have to consider that. You have to divide that into long term, short term based on the remaining assets. If the remaining assets are long term, then the capital gains is long term. If the remaining asset is short term, then the capital gains is short term. If the remaining asset is self-generated goodwill, then the capital asset is short term. And what ratio you are going to divide that? On the basis of ratio of the revaluation, increase in revaluation. That ratio you are going to consider. So this is what I have done it over here. Now, the next questions are based on this question only. Now, the next question is exactly based on this question. You don't have to worry about all those things. Okay. Now, pay attention, please. The next question is what? Question number 3, we have already done. Question number 4. What will be the amount apportioned to the land at Pune and the land at Mumbai, X and Company, to be reduced from the full value of consideration for computing capital gains of such asset when sold at the future? Now, this 23 lakhs, whatever is the capital gains, this will be apportioned to the remaining assets. In what ratio? That I have told you. In the ratio of the revaluation. So whenever that remaining assets will be sold, at that time from the gross consideration of those assets, you have to remove that much capital gains. For example, what is the long term capital gains? Long term capital gains is now 17,50,000,0039. Okay. Now this will be apportioned between 2 assets, that is land at Pune, land at building. In what ratio? 135 is to 162, right? Because for land at Pune, it is 35 increase in revaluation, and land at Mumbai, it is 162. So now you have to divide this 17,20,000, 17,50,000, the long-term capital gains, in the ratio of Mumbai and Pune and Mumbai, whatever it is. So it comes to 3,10,000, 14,39,118. Now this is the amount which will be reduced from their sale consideration in future. Check it, please. A beautiful question it is. It's a beautiful question. It's a very beautiful question. And last but not least, if self-generated goodwill is sold in previous year 22-23 in previous year 23-24, sorry, for 80 lakhs, what would be the capital gains on such sale in AY 24-25? So what will happen if self-generated goodwill will sold? So for self-generated goodwill, the cost is nil. The sale consideration is 80 lakhs, and whatever capital gain was charged earlier and which was attributed to self-generated goodwill, that will be reduced from the cost of acquisition. How much was attributed to the self-generated goodwill? This much amount. Yes or no? 621, 841 was short term, na? It was attributed to the self-generated goodwill. So this much will be reduced whenever the goodwill will be sold in future. And this much will be reduced whenever will be the land in Pune and land in Mumbai will be sold in future. So this will be reduced, and whatever will be the amount which will come after that, that is 73,78,159. Check it, please. So this is what this great question is all about. I hope you all have enjoyed it. So go through it once and then we'll move ahead with the next one. Okay. Now let's move on to the third question, third case scenario based MCQs. So let's start with the first answer. Which of the four entities are eligible to declare income on presumptive basis under the Income Tax Act 1961 for AY 23-24? So let's see which of the entities are eligible. Let's see one by one. Is AB and Company eligible? Yes, AB and Company is eligible because AB and Company is a partnership firm and it is doing retail business and the turnover is up to 200 lakhs. That is up to 2 crore. Therefore, it is eligible for claiming 44AD. 44AD benefit is available for AB and Company. Now let's see, is LM and firm also eligible? Yes, LM and Company firm is also eligible for 44AE, that is the truck wala section, goods carriage wala section. Third, is PQ and Company eligible? PQ and Company is not eligible because PQ and Company is an LLP and it's doing wholesale trading business, and wholesale trading business 44AD is not eligible for LLP. So PQ and Company is not eligible. Okay. Last but not least, is XY and Company eligible? XY and Company is eligible, and because it is doing interior decoration and the gross receipt does not exceed 50 lakh rupees, and therefore it is eligible for claiming benefit under 44ADA. Therefore, out of 3, only PQ and Company is not eligible. Rest of the 3 are eligible, and therefore the answer to this question is this particular point. Okay. AB and Company, LM and Company, XY and Company. I hope it is clear to all of you. Next one. Question number 2. What is the business income to be declared by AB and Company and PQ and Company for AY 23-24, assuming that the entities wish to make maximum tax saving without getting their books of accounts audited? So AB and Company and PQ and Company, we are supposed to compute the deemed income without getting their books of accounts audited. So AB and Company, let's see. For AB and Company, the total gross receipt and turnover is 200 lakhs. Now out of that, 150 lakhs plus another 20 lakhs. 150 lakhs and another 20 lakhs is received within time, within the due date of filing of return, and that too by NEFT and RTGS. So on 170 lakhs, the deemed income will be 6%. And on remaining 30 lakhs, the deemed income will be how much? The deemed income will be 8%. So for AB and Company, for 170 lakhs, the deemed income will be 6%. For remaining 30 lakhs, the deemed income will be 8%. And therefore, that comes to 12.6 lakhs. Okay. For PQ and Company, presumptive income is not applicable only. And for PQ and Company, because the presumptive income is not applicable, for PQ and Company, directly you are supposed to take the actual profit only. And the actual profit is 4.5 lakhs because for PQ and Company, presumptive income is not applicable. So you have to directly take 4.5 lakhs as their profit. Okay. And therefore, their profit is how much? Their profit is 4.5 lakhs. And therefore, the answer to this question is 12.6 lakhs and 4.5 lakhs respectively. For AB and Company, presumptive income is applicable. For PQ and Company, directly the actual profit will become their final profit. Okay. Next, question number 3.3. What is the business income to be declared by LM and Company for assuming that the firm wishes to make maximum tax savings without getting its books of accounts audited? Now, who is LM and Company? LM and Company is that goods carriage assessee. For goods carriage assessee, you need to see the breakup of the vehicle. And in that case, you have to first of all segregate all the vehicle into 2 categories. Light motor vehicle, heavy motor vehicle. What is a light motor vehicle? If the weight, gross weight is up to 12,000 kg, then it is light. If it is above 12,000 kg, then it is heavy. Therefore, on that note, this is light, this is light, this is light, this is light, and even this is light because the weight does not exceed 12,000 kg. If it exceeds 12,000 kg, then it is heavy. Okay. So this is also light. And the last one is what? The last one is considered to be a heavy vehicle. For light vehicle, the deemed income is 7,500 per month for per vehicle. For number of months, the vehicle is what? The vehicle is owned by the assessee, not used by the assessee. Usage is not important. For us, what is relevant is ownership. The deemed income will start from the date on which you purchase the vehicle. It will not start from the date on which you will use the vehicle. Usage is not relevant in this section. Therefore, date of use, you have to just strike it off. That is of no use. That is given just to confuse you. Okay. Now, you have to compute the deemed income. So, for first vehicle, it is 7,500 into 3 into 11. 11. Why? Because from May to March it is 11. For second vehicle it is 9 months, because from July to March it is 9 months. For third it is August, so August to March it is 8 months. For fourth vehicle it is September, so September to March it is 7 months. For fifth vehicle it is 5 months, because from November to March it is 5 months. And for last vehicle it is 4 months, because from December to March it is 4 months. For last vehicle you have to take 1000 rupees per month per ton. So for last vehicle the deemed income will be 13,000 rupees. For rest of the vehicle the deemed income will be 7,500. With that note, it comes to 6,36,500 rupees. 636,500. Now, one important benefit which is given to 44AE assessee, that is, if you are covered by 44AE assessee, then you are also eligible for the benefit of what? Remuneration given to partners and interest given to partners up to 12%. This benefit is not available for other assessees. This benefit is not available to 44AD and 44ADA assessees, but this benefit is available for 44AE assessee. We have done this interlinking in our color easy notes books also. Very beautifully we have done multiple place interlinking of this particular point. Therefore, I will also give a deduction of 2 lakh rupees over here, which I have not given in the previous question and for under 44AD. Under 44AD, if you are following presumptive income, then the benefit of remuneration and partners and interest to partners is not allowed. Even in 44ADA it is not allowed, but here it is allowed. Therefore, this will come to 436,500. I'll just change this answer to, this is 436,500 and this is 636,500. There is a mistake over here which I have written over here. Okay, I have done a mistake over here. I am changing that. Okay, that's a clerical mistake. Now, the next question is what? The next question is question number 4, which is very, very simple. What is the income to be declared by X and company? That is the last one, that is engaged in some profession, interior decoration, for AY 23-24, assuming that the firm wishes to make maximum tax saving without getting the books of accounts audited. So it's very simple. It's what? The turnover of the firm is 50 lakhs and you have to take 50% of that. 50% of that will come to how much? 25 lakhs. Is the firm going to get the deduction of what? The deduction of remuneration and interest? No. Even in 44ADA, the deduction of remuneration and interest is not allowed. The entire question revolves around this only, that whether to take the deduction of interest and remuneration or not. In case of 44AE, you can take. In case of 44AD and 44ADA, you are not allowed to take. So here, you are not allowed to take the deduction. You have to take directly 50% and 50% of that comes to 25 lakhs. It is as simple as that. Okay. And one last question. Would your answer to question number 3.3 and 3.4 change if the firm decide to get their books of accounts audited? Now, question number 3.3 was on LMN company. So let's talk about LMN company first. So if LMN company decides to get the books of accounts audited, if it decides to get the books of accounts audited, then the profit will reduce to 4.91 lakh. Now the profit is 436,500. So it is better that if they get the books of accounts audited. Therefore, the answer in case of LMN company will change. Even the answer in case of the last company, XY and company, will also change, because in that case also the profits will reduce to what? 20 lakhs. So if they do not follow 44ADA, then they are eligible to get what? The deduction of remuneration and interest, and therefore their profits will reduce what? To 20 lakh rupees. Therefore, in both the cases, it is better to go for what? To go for the actual profit, do audit, find out the actual profit, because in both the cases the profits will reduce further and it is better for the assessee. Okay, so in both the cases the answer will change and that is what the question 3.5 is all about. So this is what, it's a simple question, nothing great, but it is on a very important concept that in case of 44AD and ADA, you do not get the deduction of remuneration and interest, but in case of section 44AE, you get the deduction of remuneration and interest. Okay. So let's move on to the next question, that is question number 4, which is based on section 50C, which is based on section 43CA, which is based on 56(2)(10), and then last one is 194IA. These are the few provisions which are applicable in this particular question. Let's discuss one by one all the question. What is the amount of income chargeable to tax in the hands of Mr. Hari in respect of transaction of sale of building to Mr. Rajesh, and under which head it is taxable? Okay, so let's see what Hari is doing. Hari is exactly a property dealer. So whatever property he will sell, it will be chargeable as a PGBP income. And if a PGBP income is applicable, then 43CA will be applicable, not 50C. 50C is applicable if you transfer a capital asset. And if you transfer not a capital asset but a stock in trade, then 43CA is applicable. Now, Hari is selling the property at 100 lakhs in 2023. And on that date, the stamp duty value is 120 lakhs. Okay. But when the agreement was entered in last year, that is on 1st September 2022, at that time, the stamp duty value was 110 lakh. Now, which date stamp duty value has to be taken? On the date of sale, today, the stamp duty value is 120 lakhs. In the last year, when the agreement was entered, at that time, the stamp duty value was 100 lakhs, 110 lakhs. So, which stamp duty value should we consider? So, the law says that you can consider the date of agreement stamp duty value if you have received the advance on the day of agreement or before that, and it is received by 4 modes. So if you have received the advance by 4 modes, that is by account pay check, by account pay draft, by ECS or such other electronic mode, on or before the date of agreement, then you can take this date, this value. Okay, so the date of agreement is 1st September 2022. Okay, on that date we have received an agreement, we have received an advance by NEFT. So you can take this value 110 lakhs as your date of what, as your stamp duty value, and you can ignore 120 lakhs as your stamp duty value. Okay, now therefore now you compare your stamp duty value with your actual consideration. Your actual consideration is 100 lakhs, your stamp duty value is 110. The difference between both of them is not exceeding 110%. The difference between both of them should exceed 110%. Therefore your sale consideration will remain at 100 lakhs only. Now your sale consideration is 100 lakhs, your cost of acquisition, that is your cost of purchase, was 50 lakhs, and therefore 50 lakhs will be taxable as a business income because Hari is a property dealer. Did you understand? I hope it is, right? So coming to the next question, question number 4.2 is an extension of question number 4.1. Who is the buyer? The buyer is Rajesh. You remember that if the buyer buys an asset for inadequate consideration, then for buyer also there can be implication of gift taxation under 56(2)(10). But the condition is the difference between the actual sale and the stamp duty value should exceed 50,000. Yes, that is exceeding 50,000, 100 lakhs and 110 lakhs. That is exceeding 50,000. But one more condition has to be fulfilled to tax as IFOS. That is the difference between the actual sale and the stamp duty value should exceed 110% also. That is not exceeding. That is exactly 110%. That is not sufficient. It should exceed 110%. Exact 110% is not sufficient. Therefore, here the condition of exceeding 110% is not fulfilled. Therefore, Rajesh will not be liable for what? Any tax under IFOS. Rajesh is escaped from IFOS tax. Okay. I hope it is clear to all of you. Let's move on to the third question. Question number 4.3. What is the amount of income chargeable to tax in the hands of Mr. Ravi in respect of transaction of sale of residential house property to Mr. Valish, under which head it is taxable? So, Valish is now selling a residential house property. So, Valish will be liable for what? Capital gains. Valish is selling a residential property, he will be liable for capital gain tax. So, now, Valish is selling in 2023 for 50 lakhs. Okay. On that date, the stamp duty value is 70 lakhs. But last year, Valish has done an agreement. On which date? In August 2022, Valish has done an agreement. On that date, the value was 55 lakhs stamp duty value. So, which value to take? We can take 55 lakhs. As I have told you in the previous case also. We can take 55 lakhs. We can take the agreement value. The value on the date of agreement. Provided the money is received by account pay check, account pay draft, ECS or such other electronic mode and on or before the date of agreement. So, here you are receiving the money by cross check. That is the mistake which you have done. You should have received the money by account pay check, account pay draft, ECS or such as the electronic mode. If you would have done that, we could have taken 55 lakhs. Now, because you have made a mistake by receiving the money by cross check, we cannot take 55 lakhs. Now, we have to take under obligation 70 lakhs as the stamp duty value. Now, the sale consideration is 50 lakhs and the stamp duty value is 70 lakhs. The difference between the both of them is obviously greater than 110%, and you have purchased the property within 2 years for 32 lakhs and therefore your sale consideration will be 70 lakhs and your cost of acquisition will be 32 lakhs and your gain will be 38 lakhs. That will be short term capital gains. Why short term? Because you are selling within 24 months. You can check in the question. Because you have purchased when? You have purchased in August 21 and you are selling in what? You are selling in what? Feb 2023, which is less than 24 months. Therefore, your capital gains will be considered to be a short term capital gains definitely. Okay. So, this is what this question is all about. So, your short term capital gains is 38 lakhs. Now, what about the treatment in the hands of Valish? In the hands of Valish, the Valish has to pay IFOS tax. Why? Because Valish is buying the property at 50 lakhs, but the stamp duty value is 70 lakhs. Now, the difference between both of them, is it greater than 50,000? Yes, it is. The difference between both of them, is it greater than 110%? Yes, it is. So, for Valish, 50 lakhs minus 70 lakhs, that is 20 lakhs will be considered as income from other source under section 56(2)(10). You can check this over here. So, for Valish, 22 lakhs, 20 lakhs will be considered as income from other source under section 56(2)(10). Okay. And last but not least, is Mr. Rajesh and Mr. Valish liable to deduct TDS? Yes, both of them are buying property of 50 lakhs or more. So, if you buy a property of 50 lakhs or more, you are liable to deduct TDS. So, now both of them are liable to deduct TDS. There is one more point which you can think over here. Now, you are liable to deduct TDS on the actual sale consideration or stamp duty value, whichever is higher. This is an amendment made by Finance Act 2022, if you remember. That point is not tested over here. That point is not tested. Why they have not tested over here? That point they could have tested over here. They have only asked, are they liable to deduct TDS? Yes, they are liable. They have not asked on what amount they are liable to deduct TDS. They could have asked that. Why they have not asked? Because they don't have that much time also to amend the question. They have put the same question which was there in the last year. So they have put the same question over here. They have not considered the implication of amendment also to change the question to some extent. If they would have changed the question to some extent, it would have been a pure test of what? Finance Act 2022 amendment. But nevertheless, if it comes in exam, you will be the first person to remember it. Don't worry. Go to the question and then we'll move ahead with the fifth one. So let's move on to the next question. Question number 5. Now this question is based on provisions of 115BAA, provisions of 115BAB. It is based on tax rates and it is also based on the provisions of penalties. Okay. So these are the provisions which are covered in this particular MCQ. So what is the first question? The first question is, what would be the tax liability of B Limited for AY 23-24 if it avails the beneficial tax rates under the special provisions of 115BAA and BAB, as the case may be, by fulfilling the conditions specified therein. Assume that the gross total income reflects the computation under the special provisions. Okay, so let's talk about B Limited. Now, is B Limited, whether B Limited is eligible for 115BAA or BAB? First of all, let's find out that. It is eligible for BAB. Let me tell you how. If a company is set up between October 2019 to March 2024, if a company is set up between October 19 to March 2024 and it commences its operation of manufacturing between this period, then it is eligible for 115BAB. Okay. Now, because this company is set up between this period, it is eligible for 115BAB. Okay. And if it is eligible for 115BAB, the tax rate would be 15% plus 10% surcharge and 4% cess on its manufacturing income. Now, whether the assessee would get any deduction? Yes, it would get one chapter 6A deduction, and that is 80JJAA. And 80JJAA would be available on this employee. Total they have hired how many employees? 1000 employees. But for the purpose of these 500 employees, they are not going to get 80JJAA, because if the emoluments per month is more than 25,000 rupees, then 80JJAA is not available, not available, not available. 80JJAA is available if the emolument is up to 25,000 rupees. So this is the first case which we need to solve over here. The company was started in November 2022. So the employee will be paid the remuneration and the salary for 5 months only. Okay. Plus you will have one question. Sir, in 80JJAA it is written that you will get 80JJAA only if the employees are employed for at least 240 days. Yes, I agree. They should be employed for at least 240 days. But there is an exception where the employment is by an apparel business or a leather business or a footwear business. Then in that case, the number of days are reduced to 150 days. Now, because the assessee is an apparel business manufacturer, the number of days for assessee under 80JJAA is only 150 days. Now, if you count from 1st November to 31st March 2023, it comes to 151 days, and therefore the criteria of 150 days is fulfilled very easily over here. Okay. So the 240 days criteria is not applicable for this assessee. So now let's compute the 80JJAA deduction. The 80JJAA deduction will be computed as follows. The gross total income, first of all, of the assessee is 2 crore 80 lakhs. Assessee is going to follow 115BAB, as I have told you, because it is formed between October 19 to March 2024. Now, the 80JJAA deduction will be as follows. 24,000 rupees per month will be the remuneration into 5 months from November to March, into 500 employees, because only 500 employees are eligible. Remaining 500 employees are not eligible because their emoluments is more than 25,000. Into 30%, that comes to 1.8 crore. Therefore, the total income of the assessee comes to what? Only 1 crore rupees. That is subject to 15% tax, 10% surcharge, 4% cess, and that will come to 17,16,000 rupees. You can check this over here. Okay. So this is what the answer to the first question is all about. This is how you are going to derive the answer to the first question. Now let's move on to the second question. The second question is for what? Is for A Limited. Now what is A Limited doing over here? A Limited is formed in 2019. That is in September. Now, because it is formed in September 2019, it will not be eligible for 115BAA. BAB, sorry. For 115 BAB, the company should be formed from October to March 2024. So it is just 1 month prior to the October month, that is in September. Therefore, it is eligible for 115 BAA, that is 22% tax, 10% surcharge and 4% cess. Here also the company will get deduction of what? Deduction of what? The entire 80 JJAA, that is for these 24,000 rupees per month employee, not for 25,100 employee, because again the emolument per month should not exceed 25,000. Here the company will get deduction for entire 12 months, because the company was formed in 2019 and in the current year the employees were hired for what? For 3 years, and the current year is the third year. For third year the company gets the benefit 1920, 2021, 2122. This is the third year, the company will be getting the benefits for the entire year. Okay, now pay attention please. So company would be getting the benefits over here for the entire year, 24,000 into 12 into 500 into 30%. Okay, this is how you are going to compute your deduction over here of 80 JJAA, and on that you will reduce the deduction of 4 crore 32 lakhs, you will get 5 crore 80 lakh rupees. 22% is your surcharge, 10% is your cess, 22% is your tax rate, 10% is your surcharge and 4% is your cess, and this is what your answer is going to be, 14,59,740. Check it please. Now coming to the third question, what would be the total income of A Limited and B Limited if they do not opt for special provision of 115 BAA and BAB? So if they do not offer 115 BAA and BAB, what will happen with them? Let's talk about one by one. A Limited. So if A Limited does not offer 115 BAA, it will be eligible for additional depreciation on this 10 crore rupees. But that does not make any relevance in the current year. That they will get in 1920, right? Not in the current year. So in the current year, it will not have any impact on the income. Okay. So for A's income will remain at 58 lakhs only. It was 58 lakhs and it will remain at 58 lakhs. What about B? Yes, B's income will be impacted because B was formed in the current year. So B would be eligible for 10% depreciation, additional depreciation on this 4 crore rupees. Why 10%? Because it is used for less than 180 days. So 10% because it is formed in the current year, and therefore the B Limited would be eligible for 40 lakh rupees extra deduction. So the B's total income will be, it was 1 crore earlier, so it will get extra 40 lakhs. So B's total income will be 60 lakhs now. So B will be getting the advantage. A is not going to get any advantage over here. Okay. Now coming to question number 5.4. Now 5.4 and 5.5, both the questions are based on penalty. Okay. Now in 5.4, we are supposed to compute the penalty, assuming that it is not a case of misreporting. If it is not a case of misreporting, then 50% tax, 50% of the tax will be penalty. And in 5.4, we are computing penalty for C Limited, and we are supposed to compute the provisions as per the normal provision, not as per 115 BAA. It is written over here, follow the normal provision, do not consider the special provision. So for normal provision, we are supposed to compute the tax. For that, we need to see the turnover of last year. The turnover of last year of C Limited is more than 400 crore rupees, as you can see. And if the turnover of last year is more than 400 crore, then in the current year, the tax rate will be how much? The tax rate would be 30%. So in this question 5.4, the tax rate would be 30%. Now, to compute the penalty, first you are supposed to compute the underreported income. The underreported income is nothing but the income assessed, that is 20 crore, minus income processed, that is 16 crore. So therefore, underreported income is 4 crore. Now you are supposed to compute tax on this 4 crore. How? Tax on underreported income plus processed minus tax on processed income. So you will compute tax now. While computing the tax, you will apply how much rate? 30%, because the turnover of last year is more than 400 crore. So 30% tax plus how much surcharge? Now 12% surcharge, because the total income in both the cases more than 10 crore. So you will apply 30% tax, 12% surcharge because the total income is greater than 10 crore, and 4% cess. If you do that, you will get the tax as the differential tax between both of them as 1 crore 39 lakh 77,600, and you are supposed to take 50% penalty because they are said though you do not consider that as misreporting. So 50% of that will come to 69 lakh 88,800, and that is going to be your penalty amount. Okay. Similarly, in last question, they have said that compute penalty for D, and for penalty for D, consider that it is misreporting. If it is misreporting, then you are supposed to take 200%. For D also, you are supposed to compute the tax rate. For D, the turnover of last year is just 251 crore. And because it is less than 400 crore, the normal tax rate of D will come to how much? It will come to 25%. Now, for D also you are supposed to compute the same thing. Income assessed minus income processed, that comes to 2 crore. And then on that 2 crore, you are supposed to compute tax. How? Tax on income processed plus underreported income minus tax on underreported income. And then you will compute tax. Now, how much? 25% tax. Plus how much surcharge? 12% surcharge, because again the income is more than 10 crore. And then how much cess? 4% cess. You will get the answer as 58,24,000. And that how much? Penalty, 200% of the penalty will be imposed on that much amount, and that will come to 1 crore 16,48,000. Check it please. And this is what this case scenario 5 is all about. Okay, it's a simple one, nothing great as such. So let's move on to the next MCQ, that is MCQ number 6, which is purely based on your business trust topic. Okay, entire MCQ is based on your business trust topic. Now, in business trust, what happens? You should be knowing the treatment, what happens of the rental income, what happens for the interest income, what happens for the dividend income, what happens for STCG under 111A, so on and so forth. Okay, so let's talk about one by one all the effects. So you have to do the entire topic over here. Entire topic is asked over here. In respect of the component of interest income from Z Limited distributed by business trust to its unit holder X and Y. Now who is Z Limited? Z Limited is an SPV. So whatever interest income is earned from SPV by the business trust, that is exempt in the hands of business trust, but that is taxable in the hands of the investor when it is distributed to the investor. And when you distribute that to the investor, you are supposed to deduct TDS, because that interest income is taxable in the hands of the investor. So at what rate you are going to deduct the TDS? If the investor is a resident, in case of Mr. X is a resident. So in case of resident, you are supposed to deduct TDS at the rate of 10%, and in case of non-resident, you are supposed to deduct TDS at the rate of 5% plus 4% cess, that is 5.2%. So in case of resident, you will deduct TDS. In case of Mr. X, who is resident, you will deduct TDS at the rate of 10%. In case of non-resident, you will deduct TDS at 5.2%. Okay, so whatever interest is earned by business trust from SPV is exempt in the hands of business trust, but taxable in the hands of the investor when it is distributed. So if it is taxable, you have to deduct TDS at 10% to resident, and for non-resident it is 5% plus 4% cess, that is 5.2%. The second question in the same question is on how much amount you are going to deduct the TDS. So for that you need to find out the percentage of holding. That is, the total unit holders are 5,000, out of which the resident unit holder is only 100, and therefore 100 divided by 5,000 will come to 2%. So the resident unit holders are only 2%. Mr. X is only 2%, but the non-resident holder Mr. Y is 500 units holding, therefore the non-resident unit holder is 10%. Okay, now the amount you will get it from here. The interest is 10 lakh, therefore the resident unit holder is 2%, therefore 2% of 10 lakh will come to 20,000, and the non-resident holder is 10%, Mr. Y, and therefore 10% of 10 lakh will come to 1 lakh. So in case of Mr. X, the TDS will be deducted on 20,000, and in case of Mr. Y, the TDS will be deducted on 1 lakh rupees. Okay, now the second question, question number 6.2. The business trust is further earning short-term capital gains of 111A. This is the sale of listed shares. So 111A short-term capital gains will be taxable at 15% plus 4% cess for business trust, and the short-term capital gain on sale of developmental property, this comes under other income. This will be subject to MMR for business trust, and this will be taxable at 42.744% for business trust. So 111A short-term capital gains is taxable at 15% plus 4% cess, but other short-term capital gains are taxable at MMR for business trust. You can check this over here. Okay, now the third one is the dividend income. The business trust is earning some dividend income from the SPV, and that income is always exempt in the hands of the business trust. In the hands of the business trust, that income is always exempt. Whatever dividend is earned by business trust from SPV, that is exempt. But when that dividend will be distributed to the investor, that is exempt or not, that depends upon the status of SPV. If the SPV has not opted for 115BAA, then the dividend is exempt. And if the SPV has opted for 115BAA, then the dividend is taxable. So in this question, the SPV has not opted for 115BAA. Therefore, this dividend will be passed on. Whenever it will be passed on to the investor, it will be exempt in the hands of investor also, and in the hands of business trust, it is always exempt. So in this question, the business trust will not pay tax on dividend, even investor will not pay tax on dividend, because the SPV is not following 115BAA. The next question is exactly opposite of the previous one, which tells us to assume that the SPV follows 115BAA. So in that case, what will happen? business trust will never pay tax on dividend from SPV, but now the investors will start to pay tax on that much amount because the SPV is following 115BAA. So now the dividend cannot be exempt in the hands of the investor. It will be taxable in the hands of the investor. Okay. Next question. Question number 5. The business trust is earning some interest income from unlisted debentures. This is considered to be other incomes by the business trust. This is not a special income by business trust. Therefore, this other income by business trust, which is interest on unlisted debentures of some company, will be subject to MMR, that is 42.744%. Okay. And last but not least, the business trust is earning some rental income from the properties invested in the market. That income is exempt in the hands of the business trust, but when passed on to the investor, it is taxable in the hands of the investor. So what is the TDS rate? In case of resident investor, you are supposed to deduct TDS at the rate of 10%. In case of non-resident investor, you are supposed to deduct TDS at the rates in force. On how much amount? On 2% and 10%, because Mr. X holds 2%. So the total rental income is how much? 20 lakhs. So 2% of that will come to 40,000 and 10% of that will come to 2 lakh rupees, as you can see in this particular question. So Mr. X and Mr. Y, it will be 40,000 and 2 lakhs, that is 2% investment and 10% investment, as the case may be. And the TDS rate in case of resident will be 10%. In case of non-resident, it will be how much? It will be just it will be rates in force, which is not mentioned in the law. Okay. So this is what this question is all about. A simple one, nothing great as such. So now let's move on to the next question, that is question number 7, which is again based on a question of penalty only. We have to compute penalty, and the first 2 questions are theoretical questions. Okay. So the first question is 7.1. Mrs. MNO is deemed to have underreported its income since. Now when underreported is considered, is the difference between the this and this is considered to be underreported? Never ever. Underreported income will always come if there is an assessment. So the difference between this assessed and the previously processed is considered to be underreported, or the difference between 147 and 143 can be considered as an underreported income. But the difference between 143.1 and 139.1 is not considered to be underreported income. That amount is not subject to penalty. Okay. So answer to this first question is this: if income exceeds 133, income assessed under 143.3 exceeds the income determined in 143.1, then it is underreported income. Or income reassessed under 147 exceeds its income assessed under 143.3, then it is underreported income. Therefore, the answer to this question is 2 and 3. Okay. So it's a simple question. Next one. Mr. N, who is a partner of the firm, is deemed to have underreported income. Now he has not filed his return of income. So a person who has not filed the return of income, when it is said to be is underreported income. A person who has not filed the return of income, it is said to be underreported income when his income assessed exceeds the basic exemption limit. So in this case, he is said to be deemed to have underreported his income since he has not filed the return and his income exceeds the basic amount which is not chargeable to tax. So the answer to this question is point number 2 and point number 3. The first 2 questions were very theoretical in nature. Okay. Now coming to the third question. In third question, they are telling us to compute penalty at the time of assessment. Okay. So at the time of assessment, we are supposed to compute penalty, and we are supposed to compute penalty assuming that it is not a case of misreporting. Therefore, the penalty imposed will be how much? Will be 50%. Okay. So now how we compute penalty? The computation of penalty is very simple. Income assessed, that is 65 lakhs, minus income processed, that is 50 lakhs. This is your underreported income, that is 15 lakhs. Now while computing the tax, you have to compute tax as follows. Tax on income processed plus income underreported income minus tax on income processed. So you are supposed to compute tax on that. What is the tax rate for a partnership firm? It is 30% plus 4% cess, that is 31.2%. Okay. So 31.2% tax you will impose, you will get 4,68,000. Of that, you will take 50% penalty, you will get 2,34,000 as your penalty. So it's a very simple question once again. Now question number 7.4. 7.4 talks about misreporting. If it is misreporting, we have to take 200%. Now, but we have to compute penalty now at reassessment. So when you compute penalty at reassessment, you have to compare your income reassessed minus income previously assessed. So the income reassessed is 85 lakhs, income previously assessed is 65 lakhs, therefore under reporting is 20 lakhs. So now compute tax in the routine manner. Tax on under reporting plus previously assessed minus tax on previously assessed. That comes to 31.2%. You have to take the tax rate. That will come to 6,24,000 rupees. So of that you have to take 200% penalty, because the question says that take as misreporting, and therefore the penalty will come to 12,48,000 rupees, as you can see in the answer. Answer is C. Okay. And the last but not least is the penalty with respect to Mr. N, who has not filed his return of income and his income assessed is 15 lakhs. So a person who does not file his return of income and his assessed income is 15 lakhs, how will the underreported income will be computed? Underreported income will be income assessed minus the basic exemption limit. This is the formula given by the law. So income assessed is 15 lakh, basic exemption limit is 2.5 lakhs. Therefore, the underreported income will be 12.5 lakhs. Now, how to compute tax? Am I going to compute tax on 12.5 lakhs? No, no, no. It will be wrong. You have to compute tax on 12.5 plus basic exemption limit. This is again a formula given by the law. Now, you have to compute tax on 15 lakhs only. On 15 lakhs, the tax will come to 273. The basic exemption limit is 2,50,000 because the assessee is less than 60 years. His age is 58 years. You can see in the question. Okay. So, therefore, his total income will be what? 15 lakhs, and on 15 lakhs, the tax will be 273. Again, it is a case of not on misreporting. Therefore, you are supposed to take 50% tax, and therefore, the penalty over here will come to how much? Penalty will come to 136,500, and underreported income will come to 12,50,000 rupees. You can check it. It's a very, very simple question. Okay. So now let's move on to the next MCQ, and this is a beautiful MCQ on the provisions of LIC, life insurance policies, and the provisions of the ULIP amendment made by Finance Act 2021. That is 4th proviso and 5th proviso to section 1010D. So it's a beautiful provision, beautiful question. Let's go through it one by one. Question number 8.1. What is this question all about? Let's talk about this. What are the life insurance policies excluding ULIPs in respect of which Mr. Manoj would be eligible for exemption under 1010D in respect of maturity proceeds, and what is the quantum of deduction which would be available under section 80C? So we are supposed to do two things over here. We are supposed to only consider the life insurance policy, ignore ULIP as of now for this question, and you are supposed to compute two things. First of all, the exemption. Second thing is the deduction under 80C. Now there are only two life insurance policies over here, policy A and policy B. Okay. Now both the policies are issued after 1/4/2013, and if the policies are issued after 1/4/2013, if you want the exemption, then the premium paid should not be exceeding 10% of the sum assured. So in first case, that is in policy A, the premium paid is 50,000, but the sum assured is 6 lakh. So the premium paid is less than 10% of sum assured. So policy A is completely exempt, and for policy A, you are going to get 50,000 rupees premium deduction under 80C. Okay. Now for policy B, the premium paid is 40,000, but the sum assured is 3,50,000. Now the percentage is more than 10%. It is 11.2% to be precise. So now this policy will be taxable. This will not be exempt. Therefore, policy A is exempt, policy B is taxable. And out of this policy, you will be getting only 10% of the sum assured as deduction, and 10% of sum assured is 35,000. And therefore, you are going to get 85,000 as deduction, and only policy A is exempt. So the two questions which have been asked in this question is, which policy is exempt? Only A. And how much deduction? Deduction will be 85,000 rupees. Okay. I hope it is clear to all of you. Now, the next question is the most important question of this particular entire case scenario. Which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption under 1010D in respect of maturity proceeds? Choose the option most beneficial to Mr. Manoj. Now, be very careful. The new amendment which has been brought by Finance Act 2021 is only applicable if the ULIP is issued on or after 1st Feb 2021. Therefore, this new amendment is applicable to ULIP C, it is applicable to ULIP E, it is applicable to ULIP F, but it is not applicable to ULIP D because the ULIP D was issued before 1st Feb 2021. So, in case of ULIP D, you are just going to check the percentage criteria. The amount criteria is not relevant. Only the percentage criteria is relevant in case of ULIP D. So, you have to just check whether the percentage exceeds 10% of sum assured or not. The sum assured is 30 lakhs and the amount is what? Amount is 3 lakh. So, this is exactly 10% of sum assured. So, 100% guarantee ULIP D is exempt. Now, we have to talk about other ULIPs. For other ULIPs, you have to check first of all the percentage criteria. The percentage criteria is fulfilled every year, everywhere, in all the ULIPs. ULIP C also, ULIP E also, ULIP F also, the percentage criteria is fulfilled. But now you also have to see the amount criteria. Now, amount criteria, you can either make exempt ULIP C and E together, or you can either make exempt ULIP F. You cannot make all the three ULIPs exempt. It is not possible. Be very careful. You have to take a decision. Either make F exempt or either make C and E exempt. Because if you make C and E exempt, the total premium does not exceed 2,50,000. Or if you make F exempt, then also total premium does not exceed 2,50,000. Now, which one to choose? We have to choose the most beneficial one. So, for that purpose, what I am doing, I am assuming that all are taxable. and I'm computing capital gains of all three of them. Suppose the C, E and F, all three are taxable, let's assume, and let's compute the capital gains of all three of them. The first one has a consideration of 11 lakhs, the second one has a consideration of 17 lakhs, and the third one has a consideration of 28 lakhs. Now, how will you compute the cost? Cost is nothing but the premium paid over the years. All of them have paid premium for 9 years. You can check from the date on which the policy has started till the date on which the policy is getting mature. All of them are making premium payment for what? How many years? For 9 years. So for the first case, the premium is 9 lakhs, second case it is 12 lakh 60, and third case is 2 lakh 22 lakh 50,000. And in the first case, the capital gains would come to 2 lakh, in second case it would come to 4.4, and in third case it would come to 5.5 lakhs. Now you only think which one is beneficial. Which one is beneficial? Should we exempt these two or should we exempt only F? It is always better over here to exempt these two rather than exempting what? F. Because if we exempt C and E, the C and E total exemption will come to 6.4 lakhs, and if we exempt only F, the exemption will be 5.5 lakhs. So it is better you pay tax on 5.5 lakhs and exempt 6.4 lakhs. Is it clear? And therefore the policy would be C, E and D, and therefore the answer to this question, the most beneficial is C, D and E, and pay tax on F. And on F, how much tax you will pay? On how much amount you will pay tax? On 5,50,000, and that is the next question. Question number 8.3 talks about that only. On how much amount you are going to pay tax on F? On F, we are going to pay tax on 5,50,000 rupees. You can check that question. Okay. Is it clear? Next question is also a very intelligent question. Mr. Manoj, tax liability we are supposed to compute. Now, what is the total income of Mr. Manoj? What all things Mr. Manoj has earned? Mr. Manoj has first of all earned dividend income of 12 lakh rupees. So, I am writing this over here. Then he has earned long-term capital gains on sale of land. So, I am writing this over here. And Mr. Manoj has also earned some taxable LIC matured in the current year. Do you remember that? This one, policy B. Policy B is matured in the current year. Now, policy A is also matured in the current year, but policy A is exempt, but policy B is taxable, and therefore on that Mr. Manoj has to pay tax. On how much amount he will pay tax? Same. 4 lakh rupees is the sale consideration which Mr. Manoj will receive, minus the premium which he has paid over the years. He has again paid premium for 7 years over here. You can check from 2016 to 2022. He has paid premium for 7 years. So 7 years premium of as per 40,000 per year will come to 2.8 lakh. And therefore Mr. Manoj LIC matured will be 1,20,000 taxable with respect to policy B. Policy A is a completely exempt, but policy B is taxable. So the total income, gross total income of Mr. Manoj will come to 18,20,000. Now, Mr. Manoj has made lot of investments in ATC. He has purchased some unit A, unit B, ULIP C, ULIP D, ULIP E, ULIP F. All of them will total definitely ATC. It will cross the limit of ATC of 1,50,000 rupees definitely. So in ATC, Mr. Manoj will get 1,50,000 with respect to ULIP and with respect to life insurance policies. But apart from that, Mr. Manoj has also invested in what? Tier 1 of NPS, which is subject to deduction under ATC CD subsection 1. Do you remember that? But the problem over here is the deduction under ATC plus ATCCC plus ATCCD subsection 1 total is 1.5 lakhs, and that 1.5 lakhs is already exhausted by ATC. So you will not get any deduction of this in ATCCD subsection 1. But do you remember that whatever is unallowed amount that is allowed under ATCCD subsection B to the extent of 50,000 rupees. Do you remember that? See, for this 1,50,000 you cannot claim deduction in ATCCD subsection 1 because ATC has already exhausted 1,50,000, but that extra 50,000 you can get deduction in what? ATCCD subsection 1B. So I am taking that extra 50,000 over here. So the total deduction under chapter 6A will be coming to 2 lakh, and my my net taxable income will be 16,20,000. Out of that, 5 lakhs is long-term capital gains that will be subject to 20% tax, and therefore that tax will come to 1 lakh, and remaining to 11,20,000 you are going to apply the slab rates. Okay, so after applying the slab rates, your tax would come to how much? Your tax would come to, definitely you can compute at your end, 2,58,440 rupees will be your final tax. Okay, 1 lakh long-term capital gains and then slab rates on 11,20,000. You will get this as your final tax. Okay, including cess, 4% cess. Last but not least, the company is making you payment for policy B. Do you remember that? 1,20,000 rupees net income. Company is paying you 4 lakh, but the net income taxable in your hands is only 1,20,000 rupees. So on that, the company will deduct TDS under 194 DA. Do you remember that? 194 DA is for that only, when a company makes payment to the policy holder, and if the policy is taxable in the hands of the investor. If it is exempt, then no TDS. Like policy A is exempt, so in respect of policy A, no TDS is required. But policy B is taxable, so in respect of policy B, TDS is required, and therefore 5% of net income, that is 5% of 1,20,000 will be subject to TDS, and that is going to come at 6,000 rupees. So the answer to this fifth question is 6,000 rupees. Okay, so this is what this MCQ is all about. A good question, very good question. You can go through it once and then we'll move ahead with the next one. Okay, so now let's move on to the next question, which is question number 9, which is based on TDS and TCS under 194Q and 206C1H. Let me give you one brief explanation first of all. Between 194Q and 206C1H, you should always give preference to 194Q first. And if 194Q is not applicable, then you can go for 206C1H. So now, here in the first question, very first question, they are asking that who is liable for TDS and by which date the TDS has to be deducted, etc, etc, etc. So in this case, there are three persons who are buying. There are three buyers, Mr. Sunil, Mr. Shriram and Mr. Sham. There are three buyers who are buying some goods. But the turnover of Sunil and Shriram is not exceeding 10 crore. So Sunil and Shriram are not liable for 194Q. But Mr. Shams is liable for 194Q because his turnover is exceeding of last year more than 10 crore. Now, what is the point of taxability? What is the point of deduction in 194Q? In 194Q, you are supposed to deduct the TDS when the at the time of payment or at the time of credit, whichever is earlier. Okay, and when your purchase exceeds 50 lakh rupees. So in case of Sham, the purchase is exceeding what? 50 lakh rupees in the month of October. Okay, and in the month of October, it is exceeding 50 lakh rupees. So when is the account credited? Account is credited on the last day of the same month. So in the month of October, 50 lakh is exceeding and it is credited in the last day of the same month. Therefore, in case of Mr. Sham is liable to deduct TDS on 31st of October. Check it please. On 31st of October, that is on the date of credit, because in the same month they credit the books of accounts of the other person. Okay, so this is the question to the this is the answer to the first question. Okay, now the second question is asking about 9.2 is asking about that who is liable for TCS. Now, in case of two persons, that is Mr. Sunil and Mr. Shriram, TDS is not applicable. So the other person, that is the seller, is liable for TCS. Now, TCS is collected on receipt basis under 206C1H, not on receipt or debit, whichever is earlier. Be very careful. Unlike TDS, TDS is deducted on payment or credit, whichever is earlier. But TCS under 206C1H is collected always on receipt basis. So now, again, Mr. Ashwath has to collect TCS with respect to sale to Mr. Sunil and Mr. Shriram when the sale exceeds 50 lakhs. So in case of Sunil, the sale is exceeding 50 lakhs in the month of November, and in case of Shriram, the sale is exceeding 50 lakh rupees in the month of October, and the payment is received in the next month, not in the same month. So in case of Sunil, the payment of November will be received in the month of December and the payment of October will be received in the month of November. So here the TCS is collected on receipt basis. So for Mr. Sunil, the TCS will be collected in the month of December because the November payment is received in December, and in case of Shriram, the TCS will be collected in the month of November because the payment is received in the next month, not in the same month. Here the TCS is collected on receipt basis. So for Sunil, the TCS will be collected in the month of December, that is 31st December, and for Shriram, the TCS will be collected on 30th November in excess of 50 lakh rupees, and therefore the answer to this question is point number B. You can check it over here. Okay. Now the third question, question number 3 talks about what if the other person does not give the PAN. So in case of TDS under 194Q, if the other person does not give the PAN, the TDS is 5%, it is not 20%. In case of 2 section, it is not 20%, it is 5%. That is 194Q and 194O. It is just 5%, it is not 20%. And in case of 206C1H, if the other person does not give the PAN, then the TCS will be collected at the rate of 1%. You can go and check the provision. There is a straight provision given on this. Okay. Now, one last thing. There is one single transaction of Mr. Krishna, and Mr. Krishna is commencing his business. And if Mr. Krishna is commencing his business, the question of TDS under 194Q does not arise, because 194Q is applicable if the last year business turnover is more than 10 crore rupees. Now, Mr. Krishna is starting his business in the current year, so the question of TDS does not arise. So in that case, Mr. Ashwath has to collect TCS on receipt basis. So Ashwath is receiving the money on 2nd July and he is receiving the money of 60 lakh rupees. So on 2nd July on receipt basis, whenever he is receiving the money, that is on 2nd July, he will collect TCS at the rate of 0.1% on 10 lakh rupees. And this is what the answer to question number 4 is all about. You can check it once. So it's a simple question. It's a question purely based on what? TDS under 194Q and TCS under 206C1. Check it once. So now let's move on to the next question, that is question number 10, which is based on 194O equalization levy, and it is also based on 44 ADA and tax computation. Okay, so let's talk about this question now. First of all, in the first question they are asking us, is Indeco Academy required to deduct tax at source on the amount received or receivable by Mr. B, and what is the amount of tax to be deducted? Pay attention. This is the provision which is based on that Amazon section 194O e-commerce operator. Now, Indeco Limited, yes, they are liable to deduct TDS on 2 lakh rupees, 1 lakh 50, 140, because Mr. B is selling these services through the website of Indeco. So, they are liable to deduct TDS on this much amount. They are also liable to deduct TDS on the amount which is directly received from the customer. Do you remember that? If the customer directly makes the payment to the seller, then also the TDS liability is on the website only, is on Amazon only. So, Indeco Limited is liable to deduct TDS on this entire amount, which comes to 4 lakh 90, and also on this 20,000 rupees, that is 5 lakh 10,000 rupees. At how much rate? At 1%. But unfortunately, the other person, the buyer, does not, the seller does not give PAN, and he does not give Aadhaar also. Instead, he is giving driving license. What is the use of driving license? Driving license doesn't have any relevance under income tax law. Therefore, because he is not giving the relevant documents PAN or Aadhaar, the TDS will be 5% on 5 lakh 10,000, as he is not giving PAN and Aadhaar, and therefore 5% on 5 lakh 10 will come to 25,500 rupees. I hope it is clear to all of you. Okay. Now, coming to question number 10.2. Is Mr. N required to deduct TDS under 194J? Now, who is N? N is an independent person. Let us see over here. N is a person whose last year's turnover is more than 1.2 crore rupees, whose last year's turnover is more than 1 crore. Now, Mr. N is an individual whose last year turnover is more than 1 crore. So, for him, 194J is applicable if he makes the payment for business purpose. Now, he is making payment of 40,000 for business purpose. So, on 40,000, he is liable to deduct TDS at the rate of 10%. But on 60,000, which is for residential purpose, he is not liable to deduct TDS on 60,000, because that is going to be covered under residential purpose. That may be covered in 194M. So, is it going to be covered in 194M? Even in 194M, he is not liable to deduct TDS. Why? Because in 194M, the payment has to cross 50 lakh rupees. Only 60,000 rupees is not sufficient in 194M. So, for this 40,000 rupees, he is liable to deduct TDS under 194J at the rate of 10%. And for this 60,000, he will not deduct TDS under 194J also. And he will not deduct TDS under 194M also, because the payment is not exceeding 50 lakh rupees. So, this is what the question number 10.2 and 10.3 is all about. In 10.2, they are asking the TDS under 194J. TDS under 194J would be 40,000 into 10%. Then in 10.3, they are asking, is he liable to deduct TDS under 194M? You say no, because his payment does not exceed what? 50 lakh rupees. Okay. Now, the next question is based on what? Is based on equalization levy. Now, he is making some payment for some online services. First, he is making payment to a company known as Tumble Inc., a social media networking company which is providing some online marketing and digital marketing, having no office in India. So, in this case, he has to deduct equalization levy at the rate of 6%. Similarly, he is making payment of 1,05,000 to Doodle Inc. Now, Doodle has an office in India, but this office has nothing to do with online advertisement. You can check over here. It has nothing to do with online advertisement. So, this office is in respect of some other business only. It is not with respect to online advertisement. So, in this case also, we can assume that Doodle does not have an office with respect to online advertisement. Doodle has office with respect to some other business, but does not have office with respect to online advertisement. Therefore, in this case also, in this Doodle's case also, you have to deduct the equalization levy at the rate of 6%. The Tumble Inc. does not have an office in India, and even Doodle Inc. does not have an office in India with respect to online advertisement. So, in both the cases, you have to pay what? You have to deduct equalization levy at the rate of 6%, that is 6,600 and 6,300 of the relevant amount. Okay, 6% in both the cases. And last but not least, you have to compute the tax liability of Mr. B. For that, we need to compute the total income of Mr. B. First, Mr. B's revenue gross receipt from interior decoration is 40 lakhs. You can see over here, it is written over here. Mr. B's gross receipt from excluding the fees from online lectures, it is what? 40 lakh rupees. Apart from that, Mr. B is also earning what? 5 lakh 10,000 rupees from here. Yes or no? He is also earning 4 lakh 90 from here and 20,000 from here, 5 lakh 10,000 from here. And Mr. B is also earning 4 lakh rupees from this foreign country A. Do you remember this? 3 lakh 50,000 rupees net income after deducting 50,000 as tax. So, if I gross the income, it will come to 4 lakh rupees. So, Mr. B's total receipt is 40 lakh rupees from the interior decoration, 4 lakh rupees from the foreign country and 5 lakh 10,000 rupees from the website, etc. So total receipts of Mr. A, Mr. B, whatever it is 49 lakh 10,000 rupees. Of that, we can go for presumptive income under 44 ADA because the gross receipt does not exceed 50 lakh rupees. So for that, you need to take 50% of 49 lakh 10,000. That will come to 24 lakh 55,000. After that, you have to take tax liability of that without applying 115 BAC, normal provision. You will get 5,70,960. You can check it. Okay. So this is what this question is all about. So now let's move on to the next question, question number 11, which is based on transfer pricing 94B and resale price method and so on and so forth. Okay. So let's go through the first question. First of all, let's see this diagram which explains us the relationship between different entities. There is one entity UI Limited in India and there is one entity MINC which is an independent entity. There is one entity HINC and we have taken a loan of 50 crore from MINC and HINC is giving a guarantee of that loan. The total loan of UI is 65 crore. Out of that, 50 crore guarantee is given by one entity itself. Now you all know that if one entity gives guarantee of not less than 10% of the total borrowing of the other entity, then both of them are deemed to be associated. So with that note, out of 65 crore loan, 50 crore loan guarantee is given by HINC only, and therefore UI and H are deemed to be associate enterprise. And in that case, if any third party gives you any loan and if the associate enterprise is giving guarantee, then that loan will be subject to what? That loan will be subject to interest under 94B, which will be disallowed under 94B. Okay. So the first question is based on that only, that is 94B provision. So let me read the first question. What is the amount of interest to be allowed in the computation of total income of UI for AY 23-24? If AY 22-23 there was an interest expenditure disallowed to the extent of 4 crore under 94B. Now pay attention please, all of you. For that, we all know that how much is interest is allowed under 94B? The interest which is allowed under 94B is 30% of EBITDA. Up to 30% of EBITDA, nobody can raise any question. For that, we need to identify the EBITDA first. What is EBITDA? The net profit is 8 crore. Then add interest of 6 crore. Add 1.25 crore, add 2.5 crore of depreciation and add 1.5 crore of income tax. Okay. So once you add all these things, you will get what? EBITDA of 18 crore rupees. Now, you know that EBITDA is 18 crore. Now, how much is allowed? Up to 30% of EBITDA is always allowed. So, 5.54 crore, nobody can raise any question. Okay. Now, just wait. It's not as simple as that. You have to pay attention over here. Pay attention, please. Now, you have paid total interest of 6 crore in the current year, out of which 1.25 crore is pertaining to local borrowing. Now, that local borrowing means you have borrowed from some local bank in India and you have paid interest to them. Now, that interest will definitely be fully allowed. There is no restriction in that. That will be fully allowed. There is no restriction in that because that is in respect of not international transaction. That is in respect of a local borrowing. That 1.25 crore will be fully allowed. Now, out of 6 crore, the remaining is how much? 4.75 crore. That 4.75 crore will also be allowed because now this 1.25 crore will not come in the limit of 30% of EBITDA. 30% of EBITDA is only with respect to transactions done with a non-resident and associate enterprise. This 1.25 crore will be fully allowed. This you keep it aside. 1.25 crore you keep it aside. Now, the remaining out of 6 crore, if you remove 1.25 crore, you will come to 4.75 crore. This 4.75 crore will be allowed because the total limit is 5.4 crore. Now, you also have the excess interest disallowed of last year. Do you know that if any interest is disallowed under 94B, then it is carried forward for a period of 8 years and in the subsequent year, it will be allowed within the limits of 30% of EBITDA. Within the limits of 94B, it will be allowed. So now, 4.75 crore out of 5.4 crore will be allowed. So how much is left over in 5.4 crore now? 0.65 crore. So the last year's 4 crore, out of 4 crore of last year, you can also claim 0.65 crore in the current year. So now the total deduction which you are going to get is 1.25 crore is the local borrowing, that is without any hesitation. 4.75 crore is the balance interest of the current year and 0.65 crore because total 5.4 crore you can claim, there is no restriction in that. So with that note, you will get the total deduction of 6 crore 65 lakh. Now out of this 4 crores, 0.65 crore you are claiming in the current year. Just one step ahead I am going. and therefore 3.35 crore you can carry forward in the subsequent years for the next 7 years. Okay, so this out of this 4 crore you are using 0.65 crore in the current year, therefore 3.35 crore you can carry forward and set off in the subsequent years. Okay, so this is what the question number 1 is all about. Now question number 2 is based on resale price method of transfer pricing. Now here you are purchasing some equipment of 30 crores, you are paying some custom duty of 4.5 crore, and then you are selling to your unrelated party for 40 crores. The normal GP margin is 20%. It's a very simple question on resale price method. Resale price method, what is first step? The resale price you have to write at the first step. The price at which you bought from the associate enterprise and then resold to the unrelated party, it is 40 crore. Then you reduce the GP margin. The normal GP margin has to be reduced. So after reducing that, it comes to 32 crores. Then you have to reduce the purchase related expense like custom duty, etc. It is a purchase related expense. You have to minus that. After that, your arm's length price will come. There might be some functional difference also, but in this question, there is no functional difference. So directly you come to the arm's length price of 27.5 crore. Now, that is a 27.5 crore is your arm's length price, and your actual purchase price is 30 crores. Therefore, the differential between the two is what? 2.5 crores, and that is what your addition in the arm's length price. That is nothing but your primary adjustment. This is the answer to your question number 2. Let's move on to question number 3 now. Now there is some mistake in this solution given by the ICAI. ICAI has made one mistake over here. You can raise a ticket to ICAI and you can get the relevant answer from the ICAI. Okay, I am telling you the correct answer also. I am telling you the wrong answer of ICAI also. I am telling both the answers. Okay, pay attention please. Now pay attention over here. Here they are asking us that how much will be the secondary adjustment over here. Now. For example, here how much addition is made? 2 crore 50 lakhs. Now, if you do not bring this money within 90 days, say it is saying that the assessee has suo motu made the primary adjustment. So if the assessee suo motu makes the primary adjustment, then the assessee has to bring the money within 90 days from the due date of filing of return. So assessee has to bring the money within 90 days from 30th November 2023, and that date comes to 20th Feb 2024. And if the assessee does not bring the money within 90 days from the due date of filing of return, then the assessee has to pay interest tax on that. Assessee has to compute secondary adjustment, that is interest, and then assessee has to pay tax on that, and the assessee has not brought the money back to India. So how much interest will be charged? 2 crore 50 lakhs is your primary adjustment multiplied by SBI's money lending rate, that is marginal cost of lending rate, that is on the first day of the previous year in which the interest is charged. Interest is charged in which previous year? 23-24. So what is the rate on the first day of 23-24? It is 11.25%. So 11.25% plus 325 basis points, that is 3.25%. So the rate will come to 14.5%. Till here everything is fine. Now there is a mistake. There is a mistake done by ICAI. I will tell you. If I count from 30th November, from 1st December till 31st March, there are 122 days divided by 366 days because 2024 is a leap year. But ICAI has forgotten that to consider that as leap year, and therefore ICAI is taking 121 days divided by 365, because if I do 122 divided by 366, that is correct answer because 2024 is a leap year. Now, if I do 122 divided by 366, no answers will match. But if I do 121 divided by 366, your answer as per ICAI will come to correct. But that is wrong. In exam, what to do? Exam do this only. Whatever is correct, you have to do that. ICAI has not made the updation in the solution. They have just changed the dates by 1 year. But they forgot to change the date. When they changed the date from 2023 to 2024, they forgot to understand that there can be an implication of leap year also. You have to consider the leap year implication, which I have already told you in the class also, that you have to consider leap year in this particular financial year if it is 23-24. That is the reason the answers will not match over here. Okay. The next question. What if the money does not, if the assessee wants to pay one-time additional tax? Can assessee one-time additional pay tax and then pause the interest? Yes. Assessee can pay on 2 crore 50 lakhs, 18% tax, 12% surcharge, 4% cess, that comes to 20.9664 approximately. If assessee pays that, that will come to 52,41,600. Once assessee pays that tax, then the assessee does not have to pay any kind of interest after that. Okay. Now the next question. Next question will also become wrong because of the leap year implication. Now the assessee, ICAI is assuming that suppose the assessee pays additional tax on 15th of March. So if the assessee pays additional tax on 15th of March, then from 16th of March onward, assessee need not have to pay interest. Okay. So assessee has to reduce the interest period by 16 days because from 16th of March till 31st of March, you are not supposed to pay interest. So you have to reduce the number of days by 16 days. Again, there will be a mistake. ICAI will reduce number of 16 days from 121 days and it will divide by 365 because they did not realize only that it is a leap year. If they would have realized, they would have not made the mistake in question number 3 also. So the mistake which they made in question number 3 will again be happening in question number 5 also. Again over here, it will be what? the correct answer will be 106. 122 minus 16 divided by 366. But institute has done 121 divided by 16, that is coming to 105. And as per 105, the answer will match. But as per 106, the answer is not going to match. So check, you can check the answers. Okay. So what is the correct answer? The correct answer is what I am showing you. If I am doing it wrong, you can say in the comment box that you are doing it wrong, sir. ICAI is correct. It might be possible that I am thinking something wrong only. It might be possible I am also a human being. I am not claiming to be a god. I am a human being. You can comment in the below comment box that you are wrong, sir. ICAI is correct. Then we will accept that. You give me the justification. Okay. How I am wrong. I may be wrong. I am not saying that I am always correct. Next one. Question number 11.6. This is a very simple question which is based on deemed international transaction. Do you remember that if you directly sell to your associate enterprise, then transfer pricing is applicable? So in that case, some associate do what? They sell to third party, and then third party has a prior agreement with what associate enterprise? In that case also, it is deemed to be international transaction. Do you remember that? So this entire question is based on that. Once you read this entire provision is over here. You will come to know that your answer to this question is C. You can check this. So it's a beautiful question. Go through it once and then we'll move ahead with the next question. Okay. So now let's move on to the next question, question number 12, which is based on section 194N and section 44DB and section 3617A. Multiple provisions are covered in this particular section. The first question is, how much TDS bank is liable to be deducted under 194N in case of Mr. A and Mr. B? Now, Mr. A is a regular filer of income tax returns, and therefore, in case of Mr. A, TDS will be deducted in excess of 1 crore rupees. Now, the total withdrawal by Mr. A is how much? The total withdrawal by Mr. A is 1 crore 5 lakhs if you make the total of that. So, in excess of 1 crore, you are supposed to deduct TDS at the rate of 2%. So, on 1 crore 5 lakhs, you have to deduct 1 crore. On excess 5 lakhs, you have to deduct TDS at the rate of 2%. So, that is the answer for Mr. A. Now, Mr. B does not file the return for the last 3 years. So, in case a person who does not file the return for the last 3 years, for him the threshold is 20 lakhs. So above 20 lakhs up to 1 crore 2%, and above 1 crore it is 5%. Now Mr. B is not filing the return, for him threshold is 20 lakhs. So Mr. B is total withdrawal by Mr. B is 98 lakhs. So above 20 lakhs it is how much? It is 78 lakhs. So on 78 lakhs we are supposed to deduct, the bank is supposed to deduct TDS at the rate of 2%, and that will come to 1,56,000 rupees. Okay. So this is what the first question is all about. Second question is based on the deduction under section 3617A, which is available to a cooperative bank. So for a cooperative bank, the provision for bad debt deductions are two. One is 10% of the aggregate rural advances, that is the aggregate rural advances made at 120 lakhs, of that 10% they will get, that is 12 lakhs they will get from here, and 8.5% of the gross total income, that is 100 lakhs, 8.5%, that will come to 8.5 lakhs. So for scheduled bank, for cooperative bank, both these benefits are available. Okay, this 12 lakhs is also available, this 8.5 lakhs is also available, and totaling of both of them will come to how much? 20,50,000 rupees, and that is the answer. I have given the breakup also, 8.5 lakhs and 12 lakhs. Okay, now the third case. The third case is a question which is based on SFT. In which all transactions the bank is liable to report in the SFT? So the bank is liable to report in case of Mr. K and Mr. B. Why? In case of Mr. K, the Mr. K is making a payment of credit card bill of more than 10 lakh rupees. So if any person makes a credit card bill payment of more than 10 lakh rupees, in case of that person, you have to give what? Give the report in the SFT. If any person makes a payment of more than 10 lakhs of credit card, or if they makes a payment of more than 1 lakh in cash in credit card, then the bank is liable to report that particular transaction in SFT. Similarly, in case of Mr. B, Mr. B is making a withdrawal of more than 50 lakh rupees from current account. If any person makes a withdrawal of more than 50 lakhs from a current account, bank is liable to give that in the SFT. So these are the two transactions which the bank is liable to give in SFT. Now, the next question is, what is the penalty for SFT? Now, here the cooperative bank is issued a notice on 30th September to file the SFT by 30th October. But they did not file on 30th October, they filed on 25th of November. So they will be liable to pay some penalty. Now, what is the due date to file SFT? The due date to file SFT is 31st of May. If you do not file till 31st of May, from 1st of June, there will be a penalty of 500 rupees per day. Per day. Till when? Till the time the government send you a notice and give you the time to file the SFT. So the government has sent you the notice on 30th September and they have given you time till 30th October. So till 30th October, if you file, then you will be liable for a penalty of 500 rupees. But if you don't file till 30th October also, then from 31st of October, you will be liable for a penalty of 1000 rupees per day. Be very careful. The penalty is not going to be 1000 rupees, is not going to be started from 30th September. It will be counted after the expiry of the time limit given to file the SFT. Therefore, from 31st October, it will be 1000 rupees per day. So, here the penalty will be how much? Till 31st May, if you file, there is no penalty. Then June, July, August, September and 30 days of October. The total of all these things will come to 152 days. So, till 30th October, you are liable to pay a penalty of 500 rupees. Now, till 30th October, if you file, there is no harm. But if you don't file till 30th October, then from 31st October, there is a penalty of 1000 rupees per day. So, from 31st October till 25th November, there are 26 days, and if you take the total of both of them, it will come to 1,02,000 rupees. You can check it over here, okay? And that is the answer which is given by ICAI also. Now, one last question over here, which is based on section 44DB, which talks about business reorganization of a cooperative bank. When one cooperative bank is amalgamated with another cooperative bank, there are certain deductions which are apportioned between both of them based on the number of days, like the deduction of depreciation, like the deduction of VRS, etc., like section 32, section 35D, 35DD and 35DDA. These are the four expenditures which are apportioned between both of them. Now, what is the current year expenditure? The current year depreciation is 3,50,000 and the current year VRS is 6 lakhs. Now, you will ask how it came 6 lakhs. The total VRS incurred by the company, by the cooperative bank 2 years back was 30 lakhs. Now, we all know that VRS is divided in 5 years. It is not allowed as a deduction in one single year. So, that 30 lakhs would be allowed as deduction as 6 lakhs in 2021, then 21-22, then 22-23, 23-24 and 24-25. So, in 5 years, you will be allowed 6 lakhs as deduction. So, the total deduction in the current year is 9,50,000. How much will be allowed to the predecessor? That is the question which is asked over here. What is the deduction allowed to the predecessor cooperative bank? So, the predecessor cooperative bank will get the deduction from 1st April till 1 day prior to the date of amalgamation. The date of amalgamation is 26th Feb. So, 1 day prior to the date of amalgamation means till which date? Till 25th of Feb. So, if I count from 1st April till 25th of Feb, it comes to 331 days. So, you can compute now 9,50,000 into 331 days, divide by 365, that will be the deduction and that will come to 8,61,507. That will be allowed to predecessor and the balance will be allowed to the successor. Check it once. This is as simple as this. Okay. So, now let's move on to the next question, and the next question, question number 13, is based on transfer pricing provisions. Okay. So, there is a detail given over here, some small balance sheet is also given, some additional information is given, and the first question is, are X and Y associate enterprise? If so, why? Now, they are associate enterprise because of two reasons. The first reason is, there is a person, Mr. Ayush, who is holding, pay attention please. Mr. Ayush is holding 30% equity in X and Y both. So, if one person holds 30%, 26% of the equity shares of one company and 26% of the equity shares of another company, then both of them are deemed to be associate enterprise. This is the first reason why X and Y are associated. The second reason is, this is the balance sheet of X. This is a small balance sheet of X, and in which Y has lended 620 million. Now, the total assets of X is 1200. So, now if you see the ratio between the two, it is 51% or more. So, if one person lends at least 51% of the total book assets of the book value of the assets of the other entity, to be precise over here it is 51.67%, then both of them are deemed to be associate enterprise. So, this is also the reason because of which both of them are deemed to be associate enterprise. So, X and Y are associate enterprise because of these two reasons. Okay. Now, next question number 2, 13.2. What is the amount of primary adjustment required to be made to the total income of X? Now, what is the primary adjustment that X has to make? Now, X has taken a loan of 620 lakhs. Okay. At what rate of interest? At rate of interest 6.5. But the arm's length rate of interest is 4%. He should have taken at 4%. Why he has taken at 6.5%? So, the extra rate of interest which he is paying, which has to be added back. Now, the loan is taken in July. So, you have to compute interest for 9 months. So, 620 lakhs is the loan. Add back the additional interest 2.5% into 9 divided by 12. That will come to 1,16,25,000 rupees. You can check it. Okay. This is what this question is all about. This is very simple question. So, this is your primary adjustment. This is your primary adjustment which has to be made. 620 lakhs is the loan. 2.5% is the extra interest. Multiply by 9 divided by 12 because the loan is given in July. Next, if X has accepted the primary adjustment made by the AO on 31st March 2024, what should X do if it does not want to treat the excess money as deemed advance and include interest on the same in its total income? Now, suppose this addition is made by AO on 31st March. Now, what he should do so that he should not be liable for tax on its secondary adjustment? He can do two things. First, he can bring back the money to India within 90 days from the date of order. So he can bring back the money in India within 90 days from the date of order. Always remember, if the AO has done primary adjustment, then 90 days is not counted from the due date of filing of return. That is counted if suo motu assessee has done the primary adjustment. If the primary adjustment is done by AO, then 90 days is counted from the due date of from the date of order passed by the assessing officer. This is the first option. The second option, which is available with the assessee, pay additional tax of 20.9664 up to the date of they pay additional tax of 20.9664 on 1,16,25,000 and also pay interest till the date of payment of additional tax. After the payment of additional tax, interest will not be charged, but till the date of payment of additional tax, interest has to be charged now. So the answer will be either 2 or 3 and 4 taking together. 3 and 4 independently cannot work. Either 2 will work or 3 and 4 together will work. Okay, therefore the answer to this question is 2 or 3 and 4. Okay, now next question. Suppose the assessee did not bring the money back to India, then how much will be the secondary adjustment in 2025? What will be the secondary adjustment in 2025 if the money is not brought back to India? Then you have to take 1,16,25,000 rupees as your primary adjustment. Multiplied by 2024-25, you are charging the interest. So you have to take the SBI lending rate on 1st April 2024. That is the first day of the previous year, because you are charging interest in 2024-25. So because the question is asking for 2024-25. So 24-25 first day is 1st April 2024. That rate is 10% plus 3.25%. That will come to 13.25%. So take 13.25% of this amount. You will get the answer as 15,40,313. Okay. Next, which factor is relevant in determining whether penalty will be leviable under 270A of the Act? Will be leviable in respect of primary adjustment. Always remember, in case of transfer pricing, if the assessee does not report the transaction in Form 3CEB, that is in Form 3CEB report which he has to file by 31st of October. If he does not report the transaction, then it is considered to be a misreporting of income and he will be liable for a penalty of 200% of tax payable. So not reporting the transaction in the Form 3CEB is considered to be a misreporting and he will be liable for a penalty of 200% of tax payable. Check it please. Next, last question. Last question is telling us to swap the situation. In our original situation, X was borrower and Y was lender. Now, if we swap the situation and if X lends the money at 6.5% and the arm's length rate of interest is 4%, then in that case, the transfer pricing will not be applicable only, because the lender is already showing an income of 6.5%. If we apply transfer pricing, then the reduction of income will happen. And you all know that as per section 92 subsection 3, transfer pricing cannot apply if there is a reduction of income or if there is an increase in loss. Because of this, because already he is showing an income of 6.5%, if I apply arm's length price, it will come to 4%. Transfer pricing provision shall not be applicable in that case. So accordingly, the answer to this question is point number B. You can check it. So it was a very simple question on transfer pricing. Now let's move on to the next question, that is question number 15, which is based on a question on partnership form, etc. Okay, so let's see what is the discussion which we need to do over here. How much interest can the firm claim as deduction for AY 23-24? So this is the answer. First we need to identify how much is the interest allowed. Now we all know that the firm will be allowed only interest to the extent of 12% paid to the partners. But that 12% logic is only applicable if it is paid to partners. If it is paid to third party, then 12% criteria is not applicable, because 40B is only applicable for partners. So here the total interest which is paid by the firm is 5,40,000. Out of that, 1,20,000 is paid to the HUF of Gopal. HUF of Gopal is not a partner. That will be fully allowed. So out of 5,40,000, that 1,20,000 will be fully allowed. So I am writing that first over here, that 1,20,000 will be fully allowed. Now what about the remaining 4,20,000? For remaining 4,20,000, we have to compute it properly. Up to 12% it will be allowed. But this 4,20,000 is computed from 1st July. So I have to, and that is payable at 16% interest. So first of all, I try to find out the capital amount. Once I get the capital amount, I will easily get the amount of interest which shall be allowed to the assessee. So now this interest is paid from July. It means it is paid for 9 months. So I am converting that interest into 12 months first of all. So 9 months is 4,20,000. Then 12 months is how much? This is 5,60,000. Okay. So I got the entire year interest. Once I get the entire year interest, I will divide that entire year interest with 16% interest which is paid by the firm. So I will get my capital amount. My capital amount is 35 lakhs. Now I will compute that how much interest is allowed. 35 lakhs is the capital. The interest allowed as per 40B is 12%. But you will be getting the deduction of interest only for 3 months. Why? Because the deed was made on 1st of January. So on 1st of January, you are trying to pay interest retrospectively, which is not allowed. On 1st of January, if you are making changes in the deed, the interest will be allowed from 1st Jan only. So you will be getting the deduction of interest only for 3 months, that is multiplied by 3 and divide by 12. And therefore, your total interest allowed as per 40B will be 1,05,000 and 1,20,000 which is paid to the HUF of Gopal. So total interest allowed will be 2,25,000 rupees. Again, I'll say, first I converted 9-month interest into 12-month interest. After that, I computed my capital value by dividing 16%. Once I got my capital value, I multiplied by that by 12% rate of interest, which is the maximum allowed. Multiply by what? 3 divided by 12. That will be my final answer. Okay, this is what the answer to the first question is all about. Let's move on to the second question. How much salary can the firm claim as deduction for AY 23-24? Now remember, the firm can claim deduction of how much? Up to 90% of book profit if the book profit is up to 3 lakhs, and above 3 lakhs it is 60% of book profit. Now if I start to compute the book profit over here, that is a very big amount. How will I compute book profit? Book profit is nothing but net profit as per PNL, add remuneration, add interest which is disallowed. How much interest is disallowed out of this? Out of this 3,15,000 is disallowed, because out of this 2,25,000 is allowed, 2.25 lakh is allowed, then 3.15 lakh will be disallowed. So I have to add 4,75,000 plus 888,000 plus this, plus I will also reduce my unabsorbed depreciation, because to compute book profit you have to give the effect from section 28 to 44. So you also have to reduce the unabsorbed depreciation. So I will reduce the unabsorbed depreciation also. That amount will be a very big amount of around 14 to 15 lakh rupees. Then I will take 90% of book profit, 60% of book profit. That will come to a very big amount of 8 to 9 lakh rupees. That will not be allowed. For me, what is the allowed amount? That is only to the extent of what? To the extent of actual remuneration paid to working partner. Now, out of the 3 partner, Madhav is a non-working partner. He is a sleeping partner. So, the salary paid to Madhav will not be allowed as deduction. But the salary paid to Jay and salary paid to Gopal will be allowed as deduction. So, I will directly compute that actual salary first. 28,000 into 12, 30,000 into 12, that comes to 696. Now, if I start to compute the maximum salary, that will definitely come above 6,96,000. Therefore, I am not computing. If you want to compute, you can compute. I have told you the formula. Net profit as per PNL, add remuneration, add interest disallowed, less unabsorbed depreciation, you will get book profit. Then you can compute, you will definitely get more than 6,96,000. But it doesn't make sense. 6,96,000 is the correct answer. Okay. Now, the third question. How much business loss and unabsorbed depreciation allowed to be set off while computing total income of the firm for AY 23-24? Now remember, here section 78 subsection 1 is applicable, which says that if any partner retires or if any partner dies, then his proportionate loss will be disallowed. Now, in last year, there were 4 partners. Who were the 4 partners? The 4 partners were Jayesh died, and in respect of Jayesh, in replacement of Jayesh, there is another partner Jay who got admitted over here, right? Jay got admitted in replacement of what? Jayesh. So, the loss pertaining to Jayesh will not be lapsed, because to fill up Jayesh, there is another partner, Mr. Jay, which is his legal heir, is coming to the firm. So, loss of Jayesh will not be lapsed. But the loss of another partner, Raj, will be lapsed, because he retired, and to replace him, there is no other partner which is coming as a legal heir. So, therefore, the loss of Raj will be lapsed. So, in all, there were how many partners in the last year? In the last year, there were 4 partners. So, in the last year, there were 4 partners, out of which 1 retired in the current year. So, now in the current year, there are 3 partners. So, out of 3 lakhs divided by 4. So, every partner's loss is how much? Losses and profits are shared equally, as you can see in point number 1. So, every partner will get a loss of how much? Will get a loss of 75,000. So, 75,000 will be lapsed out of 3 lakhs, and 2,25,000 will be allowed. Therefore, 2,25,000 loss will be allowed. What about UAD? Section 78(1) is not applicable for UAD. UAD is fully allowed, fully allowed, fully allowed. So, UAD will be fully allowed at 1,50,000 rupees, as you can see over here. Next question. Question number 4 is a simple question where you are supposed to compute the total income of the firm. The total income of the firm will come as what? The net profit as per PNL. Okay. Then the interest which is disallowed. How much interest is disallowed? 3,15,000 is disallowed. So, add back that interest. Then the remuneration which is debited to PNL, add back that. and the remuneration which is allowed, which we have computed here, reduce that. Okay, then reduce the brought forward loss, which we have computed in the previous question, and then reduce the unabsorbed depreciation, that also you have computed in the previous question. Okay, after that you will get the answer as 6,04,000, and that is your correct answer. Okay, next question, question number 5. What would be the capital gains in the hands of LPG? LPG means the firm. Assuming that the land acquired from Gopal was sold on 20th of Feb for 25 lakhs. So now you are selling the land at 25 lakhs. The stamp duty value of the land is 28 lakhs. The fair market value of the land is 30 lakhs. Fair market value is of no use. They have been given to confuse us. The sale consideration is 25 lakhs and the stamp duty value is 28 lakhs. The difference between both of them is more than 110%. Therefore, you will take the full value of consideration as 28 lakhs. The cost of acquisition will be the value at which you got the land. So, the day on which you got the land, at that time, the stamp duty value was 20 lakhs. That you can take as your cost of acquisition. Okay, and therefore the cost of acquisition over here will be 20 lakhs, and therefore your capital gains will come to how much? 8 lakh rupees. So this is what this question is all about. It's a good question on partnership firm. You can go through it once. So let's move on to the next question. The next question is based on lot of provision like transfer pricing 94B, the 115 BBF is also covered, and the provisions of I guess 80 JJAA etc. is also having some implication over here. Okay, so let's see the question one by one. The first question is based on the disallowance which we have to make under 94B. First of all, we need to identify whether X and Y are associate entity or not. Yes, they are associated because it is very clearly written over here that one entity holds 30% equity shares in the other entity. Therefore, both of them are deemed to be associated. Now, if they are associated, we need to find out if one entity has taken, the Indian entity has borrowed loan from the foreign entity, then 94B will be applicable. Now, for that we need two things, that is the interest amount and the EBITDA amount. The EBITDA amount over here is 6 crore rupees as you can see, and the interest amount will be 50 crore into 6%, that will come to 3 crore. So, how much will be the disallowance? The disallowance is lower of the two, that is interest paid minus 30% of EBITDA. 30% of EBITDA will come to 1.8 crore. 30% of 6 crore will come to 1.8 crore. So 3 crore minus 30% of EBITDA will come to 1.2 crore. And the point number 2 is interest paid or payable to your associate entity, that is 3 crore. Whichever is lower will be disallowed, and the answer to this question will come to 1.2 crore rupees. Okay, so it's a very simple question. So it's a very basic question on 94B. Now coming to the second question, 15.2, which says that at what rate of tax will income of X from manufacturing business, this is the first income, dividend income, this is the second income, and FNO trading be taxed, assuming that X opts for special provisions of 115BAA or BAB, as the case may be. Ignore surcharge and health and education cess. So now be very careful. In this question, in the very first or second paragraph, it is very clearly written that the main business of X is not manufacturing. The main business of X is FNO. And if your main business is not manufacturing, it is FNO. You cannot claim 115BAB, and therefore you have to go for what? 115BAA, and in 115BAA, your entire income, all the three incomes will be taxed at 22% only. You will not get the benefit of 15% under 115BAB. 115BAB will not be eligible for you. You will get benefit of 115BAA at the rate of 22% tax over here. You can check it over here. Okay. So this is what this question is all about. Let's go to the third one. The third one is, which of the statement is correct as regard taxability of royalty in the hands of X? Now do remember that we have done in the chapter of MAT one section by the number called as 115BBF, which says that if a resident is developing some patent and then registering that patent and then earning royalty out of that patent, then it will be subject to 10% tax under 115BBF, subject to one condition, that 75% of the expenditure should be done in India. So all the conditions of that 115BBF is fulfilled over here. X is a resident, it is developing a patent and it is registering the patent, and more than 75% of the expenditure is done in India, and therefore the royalty income of X will be subject to tax at 10% on entire 5 crore rupees. Further, you do not get deduction of expenses in 115BBF. 115BBF is grossly taxable. This 42 lakh rupees deduction you are not going to get under 115BBF. It is not allowed, not allowed, and not allowed. Okay. Next question, question number 4. If X desires to avail the benefits of 115BAA or BAB, as the case may be, then which of the statement is correct? Now, whichever section he opts for, he is not eligible to opt for 115BAB obviously. Now, if he opts for 115BAA, then he will not get the additional depreciation. Additional depreciation is not allowed under 115BAA, but he will be eligible to claim 80JJAA. 80JJAA is allowed as for the assessees who opt for what? 115BAA. Rest of the three statements are incorrect. So you can go through this question. It was a very simple question, but it's an unorthodox kind of question, different kind of question. So let's move on to the next question, that is question number 16. All of you please pay attention. What is the first question in this question? The first question in this particular question is about applicability of 115JB for a foreign company. Now we know that we have learned in the chapter of MAT that 115JB, that is MAT, is not applicable to foreign company in some circumstance. Now one of the circumstances tested over here, like what? If a foreign company is of a country with which India has DTAA and that foreign company does not have a PE in India, then there is no MAT. The foreign company should be of that country with which India has DTAA and that company should not have any PE in India. They should not have any branch, office, factory, etc. in India. Then there is no MAT applicable. If they have a branch in India, then MAT will be applicable. So now let's test this particular provision over here. This is the foreign company which is registered in country A and India has DTAA with that country. Till here everything is fine. But the problem is this company has a branch in India. Now because this company has a branch in India, therefore this company will be liable for MAT. If this company would have not have a branch in India, if they did not have a branch in India, then MAT would not have been applicable. But because they have a branch in India, MAT would be applicable in this particular case. Check it please. The provisions of 115JB are attracted since it is a resident of a country with which India has DTAA and the branch is there which constitutes permanent establishment in India. Therefore, they will be liable for what? They will be liable for MAT. They should not have a branch in India. Then there is no liability on MAT. Okay. Now, coming to question number 2. What is the rate at which the FTS will be chargeable in India? Now, the FTS is chargeable as per section 115A if the foreign company or non-resident has entered into an agreement with Indian company or government or Indian concern and that agreement is approved by central government. Okay. Now, if that is the case, then 115 says that it is 10% as per 115A or the DTAA rate, whichever is more beneficial. Okay. Now, the 115 rate is 10%. Now, coincidentally here, the DTAA rate is also 10%. But always remember that the DTAA 10% is far beneficial as compared to 115A. Why? Because 115A rate is further subject to surcharge and cess. But DTAA rates are not subject to surcharge and cess. And therefore, the final tax rate of this particular assessee will be as per DTAA and that will be 10%, 10% and 10%. So, this company will be liable to pay tax at the rate of 10% on 75 lakh rupees, that is gross FTS. You do not get deductions of any PGPP expense also. You do not get deduction of any IFOS expenses also out of this particular income. Okay. Now, third question. In the third question, the company is selling some shares of a closely held company. So, if a non-resident or a foreign company sells a shares of a closely held company and that share is a long-term capital gain, then that is subject to tax at the rate of 10% without indexation. Go and check the provisions of section 112. It is mentioned in section 112 that such capital gains, such long-term capital gains whereby a non-resident or foreign company sells the shares of a closely held company, then that capital gains of long-term will be chargeable at 10% tax without indexation. So here it is written in section 112. You can go and check over there. Okay. It is written in section 112. So answer to this question is D. Okay. Coming to the fourth one. Which of the following statement is correct assuming that the rate specified in DTAA are same as the rate provided in the Act? Now be very careful. For foreign company, certain incomes are not liable to MAT, like for foreign company, dividend income, royalty income, FTS income and capital gain on security is not liable to MAT if there is a condition. It's not always exempt. It is not liable to MAT if the normal tax rate is less than the MAT rate. If the normal tax rate is less than 15%, they are not liable to MAT on these four incomes. Who? Only foreign company. Now, we need to see the capital gain rates. The normal capital gain tax rate for the company was how much? It was 10%. Was it less than 15%? Yes. So, they are not liable to MAT on capital gains. The FTS normal tax rate was how much? The FTS normal tax rate was also 10%. So, again it is less than 50%. They are not liable for MAT on this income also. So, both the incomes will be reduced from the book profit and they will not be liable to MAT on both the incomes. Okay. You can check it over here. So now let's move on to the next question, that is question number 17. Let's talk about question number 17. Is Wellness Private Limited required to get its books of accounts audited under 44AB? Now, under 44AB, a businessman is liable for audit if the turnover exceeds 1 crore. But for some people, the turnover limit is 10 crore. Who are those lucky people? Whose cash receipt does not exceed 5% and cash payment also does not exceed 5%. Let's see whether wellness is that lucky or not. For wellness, the total cash receipt is 5,50,000 rupees. Okay. Now, and the total turnover of wellness is how much? 1.1 crore. Okay. Out of 1.1 crore, 5,50,000 will come to exactly 5%. So here, in case of cash receipt, the wellness is doing absolutely proper. But when it comes to cash payment, wellness is violating the provision. Okay, here the cash payment is 5,40,000, then 70, then 90. Total cash payment is 7 lakh rupees and the total payment is 65,84,500 if I make the total of all of them. Okay, if I make the total of all of them, it is 65,84,500 and the cash payment is 7 lakh rupees. Okay, so for this purpose, the cash payment is exceeding 5% and therefore wellness will not be eligible for the 10 crore benefit. Therefore, wellness is liable for audit because the turnover is greater than 1 crore rupees and because the cash payment exceeds what? 5% of the aggregate payment. These are the two reasons because of which the wellness is liable for what? Tax audit in the current year. Now, next. What is the disallowance for non-deduction of TDS? That is the question number 2. So, the disallowance for non-deduction of TDS is wellness is liable to deduct TDS on this 35 lakh rupees under 194J, which is the remuneration paid to 20 specialists. So, for remuneration which is paid to your independent specialist, you are supposed to deduct TDS under 194J. You have not deducted, 30% disallowed. And also to the staff to salary, all of them are earning more than 5 lakh rupees. So, you have to deduct TDS in that case also as per section 192. So, in these two cases, you are liable to deduct TDS. Rest of the things you are not liable to deduct TDS because here the salary is too less, wages is too less, rest is computer, interest, here also the payment is too less, here it is advance. So, rest of the provisions are not subject to, rest of the points are not subject to TDS. So, on this 55 lakhs, wellness was supposed to deduct TDS at the rate of how much? At the rate of whatever is the applicable rate, 194J, 10%, 192 as per the slab rates. But not deducted, then 30% will be disallowed. So 55 lakhs, 30% comes to 16,50,000. 16,50,000 will be disallowed in case of wellness. Okay. Now the third question is, what is the amount of depreciation on computer? Now the computer was purchased in the month of May, but it was put to use from October. So you will get only 50% depreciation. Normally the rate of computer depreciation is how much? 40%, but you will be eligible for only 20%. Okay. But one mistake you should not make. To buy this computer, you have taken a loan on 15th of April. So the interest which you have paid from 15th April till 15th of October, that is 6 months interest, you have to capitalize. So you have to find out the 6 months interest out of this. So you took the loan and you have started paying the interest from 15th of April. So from 15th of April till 31st of March, how much time it is? It is 11 months and 11 and a half months. So for 11 and a half months, the interest is 34,500. So for 6 months, the interest is how much? So you have to make a backward calculation. So for 11 and a half months, the interest is 34,500. So for 6 months, it is how much? 6 months divided by 11 and a half months, it will come to 18,000. So you have to add 18,000 in 3,50,000. Your total cost of computer will become 368, and on that 368 you are going to take 20% depreciation because it is used for less than 180 days. Do not forget to add this 18,000 rupees. How 18,000 came? This interest is for 11 months and 11 and a half months. So 11 and a half months is 34,500. So 6 months is how much? How 6 months? Pre-construction, pre-use period. That is from 15th April to 15th October. It is 6 months period. So that much interest is capitalized, and you will get the interest. You will get the depreciation as 73,600, which is 3,68,000 into 20%. Okay. Now the period after 15th October, it will be a revenue expenditure. So you should claim that as what? As a revenue expense in your PGBP income. Okay. 16,50,000, 16,500. Next question. What is the total income of wellness for the AY 23-24? Now it's very simple. Whatever you have done so far, you have to follow that. 1 crore 10 lakh is your gross receipt. Okay. Now from that gross receipt, you will claim this deduction. Okay. You will claim this deduction. You will claim this deduction. Plus you will also disallow 16,50,000. 16,50,000 will be disallowed, right? You will disallow 16,50,000. After that, you will not get deduction of this because you are making payment of more than 10,000 rupees in cash. So if you are making payment of more than 10,000 rupees in cash, it is not allowed, not allowed, not allowed. This 5,40,000 will not be allowed too. So this will be allowed, and 16,50,000 will be disallowed. What about this? For this you will get depreciation of 73,600 that you can claim, and out of this you will get the pre-usage interest deduction of 16,500, right? You can also get this 16,500 deduction, and this 70,000 will also be allowed as deduction. This is an advance, so advance will not be allowed as a deduction under the PGBP expense. Okay, so what all deductions you are going to get? 35 lakhs, 20 lakhs, then disallow the non-deduction of TDS expense, then 5,40,000 will not be allowed as deduction. For computer you will get depreciation. For this you will get pre-use period interest 16,500 and 70,000. Okay, if you do all these things you will get the answer as 69,89,900 rupees. Don't worry about it, you'll get this answer. Okay, you can just compute. I have also given the breakup over here. And last but not least over here is there any penalty for receipt of cash? If you receive cash from someone, will you be liable for penalty? Yes, why not? If you are not supposed to receive a cash of 2 lakhs or more. So in this question, you wellness is receiving cash of 5,50,000 rupees. The transaction is of one single day. If the transaction is of one single day, then you cannot break that into 4 days and receive the cash also. That is also not allowed. The transaction is of one single day, 5,50,000. Now you cannot break that in 4 days and receive cash in 4 different days. That is also penalized under section 271 DA, and it is a violation of section 269 ST, and therefore you will be liable for a penalty of 5,50,000. Check it please. So let's move on to the next question, that is question number 18, which is based on your favorite topic, that is income from trust, taxation of trust. Okay, let's move on to this question. Very dangerous topic it is. The first question is, what is the quantum of donation taxable? Anonymous donation taxable under 115 BBC. Now, how much is the anonymous donation taxable? Anonymous donation is taxable as follows. Anonymous donation minus you get one exemption from that, one deduction from that. That is how much? 5% of total donation or 1 lakh rupees, whichever is ours. Now, what is your anonymous donation? The anonymous donation is 12 lakh rupees. Can you see this? It is 12 lakh rupees. Now, out of this 12 lakh rupees, how much will be allowed as a deduction? It is 5% of total donation or 1 lakh rupees, whichever is higher. Now, how much is your total donation? Your total donation is, you have received 60 lakhs as voluntary donation, 12 lakhs as anonymous donation, and 25 lakhs as corpus donation. So, your total donation is 97 lakhs, and you will get how much deduction of that? 5% of that as deduction. Okay, so if you take 5% of 97 lakhs, you will come to 4,85,000, and therefore your taxable anonymous donation will be 7,15,000 rupees. Is it clear to all of you? I hope it is clear to all of you. Next one, question number 18.2. Can the amount donated to poor aid be allowed as deduction? You have made some donation to poor aid, so how much will be allowed as deduction? Now, out of the current year income, you have made a donation of 5 lakhs, and out of the earlier year income, accumulated income, you have made a donation of 4 lakh. So, you will not get deduction for the donation which you have made from earlier year income. So, this 4 lakh will not be allowed as deduction at all. But out of this 5 lakh also, you will not get deduction of 2 lakh rupees, because that is given as a donation as corpus, and corpus donation is not allowed as deduction. Only voluntary donation is allowed as deduction. So, the ultimate answer will be this 4 lakh will not be allowed, and out of this 5 lakh also corpus will not be allowed. Therefore, only 3 lakh will be allowed as application to you as per the income tax law. Okay. Now, coming to the third question. Can the corpus donation received by EduAid be claimed as exempt under 11(1)(d)? If so, how much will be exempt? Do remember that whenever you receive a corpus donation, we have received a corpus donation of 25 lakhs. You have to invest that in the mode specified in 11(5). That is post office, saving bank, etc., government FDs and government shares, public sector company shares. So, how much they have invested in the mode specified in 11(5)? They have invested first 12 lakhs, and then they invested 8 lakh rupees. So, out of 25 lakh, they have invested how much? 20 lakh rupees in the mode specified in 11(5). Therefore, 20 lakhs rupees will be considered as what? Will be considered as exempt, and rest of the 8 lakhs will be considered to be taxable. Okay. Now, question number 4. What is the quantum of the amount spent on construction be considered as application in the hands of EduAid? So, in all, EduAid has incurred an expenditure of 72 lakhs on construction of school. Now, how much will be allowed as deduction out of that? How much will be considered as an application? So, let me give you the breakup. 72 lakhs is the total construction cost, but 50 lakhs is taken as a loan and then applied. Do you remember that? There is an amendment which came that if you take a loan and then you apply the income, then that is not allowed as a deduction. It is allowed in the year in which the loan will be repaid. So, out of 72 lakhs, 50 lakhs you have taken as a loan and you have applied. So, that will not be allowed as an application of income. What about the 10 lakh rupees which is repaid? Yes, 10 lakh rupees which is repaid repaid during the financial year. You can check above. 10 lakh rupees is repaid during the financial year to SBI. Can you see that? So that will be allowed as an application. So out of 72 lakhs, 50 lakhs is incurred by taking a loan. But out of that, 10 lakh is repaid as a loan, so you will be getting the deduction of that 10 lakh. What about the 5 lakh rupees which you are reducing, sir? That 5 lakh rupees is withdrawn from post office and that is applied. That is not allowed as deduction. Logic being, because that you are withdrawing from exempt income and then you are applying. And if you are withdrawing from exempt income and then applying, you will not get the deduction. So ultimately you are going to get the deduction of how much? Of 27 lakh rupees over here. Okay. Now, one last question over here is, what is the total amount which can be treated as application in the hands of EduAid? So I'll give you the breakup. First of all, you have repaid a loan of 10 lakh. So you will get 10 lakh that as an application. Then you have purchased some books of 1 lakh rupees. You can check. 10 lakh loan repaid, that will be allowed as application. 1 lakh book is purchased, that will be allowed as application. 10 lakh purchase of computer, that will be allowed as application. Now, out of revenue expense of 7 lakh, the entire 7 lakh will not be allowed. Why? Because 30,000 is paid in cash. So that cash amount will not be allowed because 48.3 will attract. Similarly, 80,000 is paid without deduction of TDS. So out of that 80,000 also, your 30% will be disallowed for non-deduction of TDS, right? So out of 7 lakh, 30,000 will not be allowed and further 24,000 will not be allowed. So out of 7 lakh, only 6 lakhs 46,000 will be allowed. So that is what I have written over here for revenue expenditure. Okay. And last but not least, for construction, you have applied 17 lakhs, which you have already break up over here. And for remaining 17 lakhs, after 17 lakhs, you have also given donation to some pure aid, etc. of 3 lakh rupees. That also we have computed in the previous question, that is 18.2. Sir, how you got this 17 lakhs? I have just broke up this 27 lakhs into two parts. That is, this 10 lakhs I have written separately over here. And that remaining 17 lakhs I am writing separately over. Instead of writing this 10 lakh and 17 lakh separately, I can write 27 lakh also together. That will also give me the same answer and the answer will come to C. Okay. You can just go through the solution once if you want. So now let's move on to the next question, and the next question is based on section 45.4 and section 45.2 subsection 2, and then also based on section 54 EC and also based on section 194 IB. Okay. Now, pay attention please. What is the first question? The first question is amount of capital gain chargeable to tax in the hands of Mr. Malika or Mrs. Malika for AY 23-24. Now, what Miss Malika has done? Miss Malika has purchased a land of 10 lakh rupees over here in Pune for 50 lakhs. And then she converted the land into what? Into stock in trade in October 2021. At that time, the FMV of the land was 300 lakhs. Now, you all know that when you convert a stock in trade into a capital gain, the capital gains is not chargeable at that time. The capital gains is chargeable on the date on which that converted land is sold. So, now it will not be taxable. It will be taxable in the year in which the converted land is sold. So, the converted land is converted into a 20 apartment. They constructed 20 apartments of equal size, equal dimension, equal quality, etc. Okay. And then they sold out of that 14 apartments in 22-23 and the remaining 6 apartments they sold in the next year. Okay. So, first we'll compute capital gains, and capital gains to the extent of 14 apartments we will tax in 2022-23, and capital gains to the extent of 6 apartments we will tax in the next year, that is 23-24. Okay. So, how to compute capital gains? For capital gains, you have to take the sale consideration as FMV on the date of conversion. You remember that? For capital gains, the sale consideration is always FMV on the date of conversion. So, the FMV is 300 lakhs. Then you will take your cost of acquisition or index cost of acquisition. Here it is long term, so it is index cost. 50 lakhs into the indexation of the year of conversion. The year of conversion is 21-22. 21-22 indexation is 317. Divided by year of purchase is 89. Okay, 2008-9. So, your cost is coming to this, your capital gains is coming to this. Now, this is not chargeable in 21-22. Out of this, proportionately, 14 divided by 20 will be chargeable to tax in 22-23 because 14 flats are sold in 22-23 and remaining 6 flats are sold in 23-24. So, proportionately 6 capital gains for the purpose of 6 assets, 6 flats, the capital gains will be chargeable in 23-24. So, let's compute that now. Now, the total capital gains is this, out of which 14 flats are sold in 22-23. So, proportionate capital gains will be chargeable now. So, into 14 divided by 20, this is the capital gains. But now, when you sold the assets, when you sold the flats in Jan 22, Jan 23, Feb 23. Now, within 6 months from that date, You have purchased some bonds of NHAI and REC. Can you see that? So if you purchase the bonds within 6 months on the date of sale of SIT, in this case you have to compute. There is a CBT circular which says that in this case you are supposed to compute 6 months on the date of sale of SIT. So from the date of sale of SIT, you have invested in these two bonds. This third one is not within 6 months. It is in September. So it is going beyond 6 months. So don't take the third one. So the first, second is within 6 months from what? From Jan and Feb. So you will take 40 lakh exemption for this particular thing. And therefore, your capital gains will come to what? 89 lakh 1460. Okay. Now, coming to the next question. Next question is asking what will be the PGBP? The PGBP is very simple. 40 flats you are selling for 14 lakhs each. So this will be your sale consideration. What will be the proportionate cost of land? The cost of land will now be the FMV, because already on FMV you have paid the tax. So now you have to take FMV as the cost of land. So 300 lakhs is the total FMV of the land. Multiply by 14 divided by 20 will be the proportionate cost of land. What is the cost of construction? 14 flats into 15 lakhs each. It is written in the question that you have incurring 15 lakhs each to construct a flat. So that is the cost of construction. So if I reduce this, I will get my what? PGBP income 140 lakhs. Okay. Now the next question is asking us the next year's capital gains and next year's PGBP. Now the next year's capital gains is very simple. The total capital gains was this, and the remaining 6 flats were sold in the next year in the month of April, I guess. So into 6 divided by 20 will give you the capital gains for the next year. But in the next year also, in September you have invested 10 lakhs in bonds. So September is within 6 months from April, right? So this 10 lakh rupees will be allowed as exemption in the next year's capital gains. Okay. So in 23-24 capital gains, you will get this exemption of 10 lakhs. Now again, you are supposed to compute what? The PGBP income. 40 lakhs is the sale price of one flat into 6 flats, 240 lakhs. 300 lakhs is the total FMV of the land into 6 divided by 20 will get you the proportionate FMV of the land. And cost of construction will be 6 flats into 15 lakhs each. And therefore, your PGBP will come to how much? 60 lakh rupees. It is very simple. It is just a copy paste of the above discussion. Now, next question. This person, Malika, is also letting out some penthouse to Mr. Harish, which was held as stock in trade. Now, it doesn't matter whether you hold a penthouse as a stock in trade or a capital asset. The rental income from a stock in trade also will be charged under income from house property only. As I have told you, the Lodha builder is letting out the property. So the let out income will come under what? PGBP? No. It will come under HP only, because the main objective of Lodha is not to let out. The main objective of Lodha is to sell. Therefore, it will be chargeable under house property only. Second thing, it is let out for 60,000 per month. But the municipal taxes are paid not by the assessee, but it is paid by the tenant. Therefore, you will not get the deduction of municipal taxes over your check. So the GAV will be 60,000 into 12, 7,20,000. Municipal tax will not be allowed because it is paid by what? Paid by the tenant, not by the owner. And you will take directly 30% deduction and your answer will come to 5,04,000 rupees. Okay. And one last thing. Is the tenant, that is Harish, liable to deduct TDS? Yes. He is liable to deduct TDS under 194 IB. Why not under 194 I? I is applicable to individual only if the last year's business turnover is more than 1 crore or last year's professional turnover is more than 50 lakhs. Now here Harish is not doing any business or profession. Harish is a salaried assessee. So for salaried assessee, 194 IB will be applicable. And in IB, you do not deduct TDS every month. You deduct TDS in the last month together for the entire year. So in the entire year, you have paid 7,20,000 as rent. So 5% of that will come to 36,000 and you will be deducting and you will be paying that rent TDS in the last month. Okay, you will be deducting that TDS in the last month, that is in the month of March. Check it please. So let's move on to the next question, that is question number 20, which is based on 35 AD, 80 JJAA and also the provisions of AMT. Okay. Now the first question asks about what is the deduction allowed under 35 AD. Now it's very clear, in 35 AD you get deduction of what? The assessee has started some 3-star hotel. Yes, 3-star hotel is eligible for 35 AD, but you do not get the deduction of what? Land and land over year. But yes, you will get the deduction of building over year. So therefore the first question is very simple. You will get a deduction of building of 175 lakhs over year. Deduction of land, goodwill and financial instrument is not allowed. Plus one more thing, you should make the payment by account pay check, account pay draft, ECS or such other electronic mode. So they have done that correctly. They have made the payment by account pay check, as you can see over here. So that is absolutely fine. Okay. Now coming to the next question. The next question is they are assuming that there is one more hotel of 4-star in Ahmedabad. So can we set off this loss against the profit of that? Yes, why not? Definitely it is allowed. So we have to first of all compute the loss of the Baroda business. So the Baroda business has a profit of how much? 80 lakhs. Now out of 80 lakhs, they will get a deduction of 175 lakhs of 3580, which we have just computed. And therefore there is a loss of 95 lakhs over here. So that this loss will be set off and carry forward as per the provisions of 73A, if you remember. 73A. So 73A is also tested over here. So this particular loss will be set off against what? Ahmedabad business. Ahmedabad business has a profit of 130 lakhs, as you can see over here, minus 95 lakhs. Therefore 35 lakhs will be considered to be your PGBP income. Okay. This will be considered to be your total income under the income tax law. Now coming to the third question, which is also very simple. The third question is saying that if out of the amount of 1.25 crore paid for acquisition of land in previous year 22-23, 75 lakh was paid in cash. Okay, what would be your answer to question number 20.1 and 20.2? Now remember, you have purchased a land of 1.75 lakhs, 1.25 crores. Okay, now out of that, if you pay 75 lakh by cash, what difference will it make? It will not make any difference. Anyways, land was not allowed as deduction. So if you make the payment by cash or if you make the payment by check, it doesn't matter. Na? It is anyways not allowed. Your answers will remain same only. Land is anyways not allowed as deduction. Now whether you pay by cash or whether you pay by check, it doesn't matter. And therefore in both the cases, the answer will remain same only. In first question, it will remain same at 175 lakhs because only building is allowed. In second question, it will remain at 35 lakhs because only building is allowed. Okay. Therefore, it will remain same as the deduction of land is not allowed. Okay. Now, question number 4 is a very intelligent question where you can make a mistake. They are asking us to compute tax by the PQR LLP based on question number 20.2. So based on 20.2, we are supposed to compute tax. So what you will do as a student, you will compute tax of 35 lakhs. 35 lakhs is the total income. So you will start to compute tax on 35 lakhs at the rate of 30% because the assessee is LLP plus 4% says, and you will say the answer is not matching. The answer will never match. Why? Because you have to compute AMT, alternate minimum tax in this case. And how will you compute the alternate minimum tax? Alternate minimum tax, you have to compute the adjusted total income. And how will you compute the adjusted total income? Total income plus deduction under 35AD, which is 175 lakhs, minus the depreciation which you could have got on that asset. Which is that asset on which you are claiming 35AD? It is building. So on that building, you have to claim 10% depreciation over here. So after you do that, you will get the adjusted total income as 192.5 lakhs. This is your correct treatment. Still the answer is not correct. You need to compute tax, not the adjusted total income. So you have to compute 18.5% of that as your what? AMT. Plus one more twist is there. Because your adjusted total income is greater than 1 crore rupees, you have to apply 12% surcharge over here. Don't forget that, otherwise your answers will not match. Plus 4% cess has to be applied. Once you do that, you will get the answer as 41,48,140. And last but not least, question number 5. What is the deduction under 80JJAA available to Mr. P? So for Mr. P, first of all, the most important point which they have tested over here, that Mr. P is engaged in the manufacturing of apparel. And for apparel business, the number of days of employment should be approximately 150 days is sufficient. Generally, if you want to claim deduction under 80JJAA, you need to claim the deduction only if you claim for, if the employee is there for more than 240 days. But here also, here it is 150 days. 150 days is sufficient for apparel, footwear and leather business. Do you remember that? So here 150 days is sufficient. Therefore, if you come to this question, pay attention please all of you. Who will get the benefit? Here you are employing in October, so it is coming to 150 days and the emolument is also not crossing 25,000. So this employee will be eligible. This employee will also be eligible because emolument not crossing 25,000 and the date of employment is also is having 150 days employment. Okay, from October to March 150 days will happen. The third employee will not get because it is emolument is more than 25,000. If the emolument is more than 25,000 per month, the benefit is not available. Fourth case will be available. Why? Because you are employing in November and from November to March it is approximately 151 days. So your criteria of number of days is fulfilled and your emolument is not crossing 25,000. It should not cross 25,000. Exact 25,000 is allowed. If it is exactly 25,000, it is allowed. See how they are testing the conditions on the edge of the point. At the edge of the amount, they are testing the conditions. And the last case, you will not be allowed because the emolument is less, but the employment of number of days will not cross 150 days. It will not be 150 days. Okay. So you will be getting the benefit for point number 1, point number 2 and point number 4. And if you multiply this, you will get these answers. And if you take 30% of that, you will get the answer. Okay. Check it please. So let's move on to the next question. The next question is based on TDS of 194Q 206C1H. These are some on 206C1G. These are some of the TDS which are TDS and TCS provisions which are covered over here in this question. Okay. Now it's a good question for the purpose of the latest amendments which have come in 206C1H, 206C1G and 194Q. So first of all, there are two people over here. One is buyer, one is seller. Buyer's last year turnover is 9.9 crore and seller's last year turnover is 10.1 crore. So now the buyer's last year turnover is less than 10 crore. So buyer is not liable to deduct TDS, but the seller will be liable to collect TCS if he sells more than 50 lakh rupees. So the first question is about that only. Who is liable to deduct TDS or collect TCS? If yes, how much and when? Okay, this is the question which they are asking. So the buyer is not liable to deduct TDS because his turnover of last year is less than 10 crore. But the seller Pranav is liable to collect TCS. When he will collect TCS? When the sale will exceed 50 lakh rupees. Now when the sale is exceeding 50 lakh rupees over here, check over here. First total sale made by him is 80 lakhs. First he is selling 20 lakhs, he will not collect TCS. Again he is selling 25 lakhs, again he will not collect TCS, 45 lakhs have gone. Now he is selling 20 lakhs, now he will collect above 50 lakhs. So 20 plus 25 has already gone, 5 lakhs further exemption from here. So on 15 lakhs, he will collect TCS on 18th of October. Is it clear? On 15 lakhs, he will collect TCS on 18th of October and on 15 lakhs, remaining 15 lakhs, he will collect TCS on 12th of February. Okay. So after the 50 lakh is crossed, he will start to collect TCS. So on 15 lakhs, 18th October and 15 lakhs, 11th February. You can check. 15 lakhs, 18th October, 15 lakhs, 11th February. This is the answer. Okay. Next question. What if the buyer does not give a PAN? Generally, if a buyer does not give a PAN, in case of TCS, the TCS is twice the rate or 5%, whichever is higher. But in case of 206C1H, it is twice the rate or 1%, whichever is higher. It is not 5%. Here, there is a relaxation given by the law. So it is twice the rate or 1%. Therefore, here, if the buyer does not give the PAN, then in that case, you have to deduct at twice the rate or 1%, whichever is higher, and therefore the higher will come to 1%. So you are supposed to collect TCS at the rate of 1% in this case. Okay. Now third question. Is Thomas Cook required to collect tax at source on the receipt of 5 lakh rupees? Now who is Thomas Cook? Thomas Cook is an overseas tour package programmer. Okay. So in case of overseas tour package program, do you remember that there is no exemption of 7 lakh. 7 lakh exemption is not available for overseas tour program and package. Not available. So Thomas Cook is liable to collect TCS on every rupee which he sells in case of overseas tour package program, and therefore on entire 5 lakh he will collect TCS at the rate of how much? 5%, 5% and 5%. Okay. The next question. Mr. Pranav is taking some loan from a financial institution for his education of his son outside India of 15 lakh rupees and he is remitting. So on that he will get first of all an exemption of 7 lakhs and then on balance amount he will be liable for a TCS of just 0.5% because there is a provision very clearly written in the law. If you take a loan from a financial institution and then you remit the money outside India for education, you will get 7 lakh exemption and the tax rate will be just 0.5%. Okay. Again, he is remitting some money from the Bandra branch of rupees 12 lakhs out of his personal saving now. Now he is not taking loan for the education of his daughter. So here also he will get exemption of 7 lakhs. But the relaxed tax rate will not be available. The relaxed tax rate is only available if you take a loan from financial institution and then remit the money. Now he is not taking loan from financial institution. He is remitting the money out of his personal saving. He will get an exemption under second proviso to section 206C1H, 206C1G. Here he will get exemption. He will get exemption of 7 lakh under third proviso to section 206C1G. So here he will get 7 lakh exemption, but he will not get the relaxed rate of 5%. Okay. So from Bandra branch, what is remitting? For that he will be getting the 7 lakh exemption, but he will not get the relaxed rate of 0.5%. He will be subject to 5% tax. Okay. Now, one last question is over here, which is a continuation of the previous question. He is remitting some money to his sister of 6 lakh rupees outside India. As you can see over here. You can see over here, he is remitting some 6 lakh rupees from Bandra branch once again. Earlier, he has already remitted 12 lakhs from Bandra branch. Yes. So now he is again remitting 6 lakhs from Bandra branch itself. He should have remitted from some other branch. If he would have remitted from some other branch, he would have got an exemption of 7 lakh. Now, because he is remitting from the same branch, he will not get an exemption of 7 lakh once again, because he has already claimed exemption while sending the money of 12 lakhs. Therefore, now on 6 lakh rupees, he will be liable for TCS of 5% directly. That will come to 30,000 rupees. Check it, please. So this is the next question, question number 22. Let's talk about this question. This question is based on 35 AD, 10 AA, then it is also based on AMT, it is also based on 44 AB, it is also based on 44 AD. Multiple provisions are tested in this particular question. Now the first thing which we have to answer over here, what is the amount of deduction under 10 AA and under 35 AD? How much deduction we will get over here? Okay. So let's talk about first of all 10 AA. In 10 AA, your profit is 60 lakhs. So 60 lakhs is your profit into export turnover. Export turnover is 120 lakhs and your total turnover is 120 plus 40, that is 160 lakhs. So therefore, the answer will come to 45 lakhs, but you are not going to get 100% deduction because the business was started in 17-18 and therefore 22-23 is the 6th year of business. Okay, and because it is 6th year of business, you are going to get only 50% deduction, not 100% deduction. So you can check this over here. You are going to get 22.5 lakhs in case of 10 AA. In case of 35 AD, it is very simple. 97 lakhs is the total expenditure that you have incurred, out of which 32 lakhs is land. Land is not eligible under 35 AD. Therefore, you are going to get 65 lakhs for land for building. Okay, so 22.5 lakhs for your 10 AA and 65 lakhs for your building. Okay, so this is your first question's answer. Next, what is the tax liability of Ganga LLP computed under the regular provision? Okay, so as per the regular provision, now it's very simple. Your 10 AA income is 60 lakhs and your 10 AA deduction is 22.5 lakhs, which we have just computed. Therefore, your 10 AA profit will be 37.5 lakhs. Your 35 AD income will be 160 lakhs. Your 35 AD deduction is 65 lakhs, which we have just computed, and therefore this is 95 lakhs. Therefore, this plus this total will come to 132.5 lakhs. So on that you compute tax as per the regular provision, because in this question they have asked regular provision. The regular provision tax is 30%, 12% surcharge, 4% cess. That's it, and your answer is ready. Okay, so now next question, and once you do that, you will get the answer as 46 lakh 30,080 rupees. Next question, what is the alternate minimum tax? For here you have to do some working. For alternate minimum tax, you have to start with what? Total income. The total income is 132.5 lakh. Then add 10 AA, 10 AA is added back. Add 35 AD, 35 AD is also added back, and then reduce the depreciation on the building as per 35 AD. The building which you have computed as deduction under 35 AD, you have to claim depreciation on that building. So that will come to 213.5, and 213.5 is your adjusted total income. On the adjusted total income, compute 18.5% plus 12% surcharge and 4% cess. You will get the deduction, you will get the tax under AMT. Okay, next question, is there any AMT credit to be carried forward? The answer is no, no, no. Why? Because your normal tax is more than AMT. AMT credit is possible if the AMT is more than normal. It is not possible when the normal is more than AMT. In this question, your normal tax is more and AMT is less. You can check. AMT is 46 lakhs 670 and normal tax is 46 lakhs 30,080. Therefore, AMT credit is not possible. Okay. Next. You have to find out Mr. Ganesh PGBB so that he get maximum tax saving without getting his books of accounts audited. So tell Mr. Ganesh to follow 44 AD. First of all, let's see whether he can follow 44 AD or not. Yes, he can follow 44 AD because his total income is his turnover is 200 lakhs. Now, because his turnover does not exceed 2 crore rupees, he can follow 44 AD. Now, we need to find out how much is received is online and how much is received in cash. 190 lakh is received online and 10 lakh is received in cash, and therefore on 190 lakh he has to consider deemed income at 6% and on 10 lakh he has to consider deemed income at 8%, and therefore the total will come to 11.4 plus 0.8, that is 12.2 lakh rupees. And last question but not least, can Mr. Ganesh declare income as per books of accounts for the year to AY 23-24 without getting his books of accounts audited? No, 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 no. He cannot do so. Why he cannot do so? I will directly tell you orally. See, for businesses, the turnover limit for audit is 1 crore. If your turnover exceeds 1 crore, you have to do audit. Some people, it is more than 10 crore also. Okay. Who are those people? For whose aggregate cash payment and aggregate cash receipts does not exceed 5% of the total payment and total receipts. But in this case, Mr. Ganesh cash payment and cash receipts definitely exceeds what? 5%. You can check it over here. Okay, it definitely exceeds what? 5% of the total cash receipt and total cash payment. Because see, here out of the total payment of 190 lakhs, 10 lakhs is paid by cash. So that will exceed 5% of total payments. Okay. Yes or no? So therefore, Mr. Ganesh is not eligible for 10 crore limit. Mr. Ganesh is eligible for 1 crore limit. Okay. Now, if he wants to show the profit lower than presumptive income, he has to get the books of accounts audited. Otherwise, he will not be able to show that. Check it, please. So let's move on to the next question, that is question number 23 now, which is based on your tonnage taxation and the presumptive income under section 44B. So the very first question is based on computation of tonnage income. Okay. So tonnage income we have to compute of VMT shipping company under 115 VG. For that we need to just read few basic background of this question. There are 3 vessels owned by this company, out of which only 2 are qualifying companies, qualifying ships. So only 2 vessels will be eligible for tonnage taxation. Okay. Now the weight of the 2 vehicles are 2 vessels are 33,840 tons and 230 kg. We will round off that to 33,800 because there is a rounding of provision on the same. And 24,952 and 370 kg also will round off to 25,000 kg because there is a round off provision for the same. Further, the first vessel was operated for 212 days and second was operated for 347 days because the tonnage income is given for daily basis. So you have to multiply the tonnage income by number of days. Okay, later on. So what is tonnage income? For first 1000 it is, for first 1000 ton it is 70 rupees for every 100 ton. For every 100 ton it is 70 rupees. Then for the next 9000 it is 53 for every 100 ton. Then for the next 14,000 it is, for next 15,000 it is 42 rupees for every 100 ton. And above 25,000 ton it is 29 rupees. So this is how it is computed. You can check the calculation in front of you. That is the reason I have written the entire calculation. So this is what the calculation will come to. But this is your daily income. You have to multiply by number of days. Once you multiply by number of days, you will get your annual income. And when you total both of them, you will get your final income of 71,20,454. Okay. So this is your first question, which is basically a computation of your tonnage income. Now, second question, they are asking us to compute the WDV of the qualifying ship. The WDV of the qualifying ship for tax purpose. Now, the WDV of the total ship for tax purpose, it is 1200. Now we want the breakup of qualifying ship. Now how will we get the breakup? There is only one way. We have the WDV as per accounts. So we will use that ratio. So that ratio will be used to break this 1200. Okay. So qualifying ship 1, qualifying ship 2, total of the accounts WDV is 850. So we'll use this breakup to break this 1200. Okay. So 1200 into 1200 is the WDV of the total tax purpose multiplied by WDV as per accounts of qualifying ship divided by total WDV as per accounts. You will get the answer. Okay. So to get the breakup of the qualifying ship as per tax purpose, we are using the WDV of the accounts. There is no other way to do that. Okay. So except doing this, we have no other option. We have to do that. We have to do this only. There is no other option available with us. Okay. So this is how we are supposed to compute this. Now third question. The minimum reserve requirement as per 115 VT. We all know that in tonnage taxation, the company has to transfer 20% of its book profit to tonnage taxation reserve account. So what is the book profit of the company? The book profit of the company is 100 lakhs. So 20% of that will come to 20 lakhs. So they have to transfer 20 lakhs rupees to what? To the tonnage taxation reserves. Okay. So what if they do not transfer 20 lakh rupees? Suppose if they transfer 15 lakh rupees, then what will happen? So that is what question number 23.4 is all about. Next question is about that. Suppose if they transfer only 15 lakh rupees, it means there is a shortfall of 5 lakhs. It means there is a shortfall of 25%. You should have transferred 20 lakhs. You have transferred only 15 lakhs. It means you have transferred 75%. You have not transferred 25%. So what will happen with that 25%? So with that 25%, you have to pay some tax now. On how much amount? Whatever is your profit from your core activity and whatever is your profit from your incidental activity. Whatever is your profit. So the core activity and incidental activity profit comes to 84 lakhs. So on 84 lakhs, you are supposed to pay 25% tax and that particular thing will come to 21 lakhs and this is your answer as per this particular question. Okay. So if you would have transferred entire 20 lakhs, there would have no implication of tax. But because you have not transferred entire 100%, you have only transferred 75% of what is required. So 25% shortfall will be subject to tax. So whatever is your profit, you have to pay 25% tax on that particular amount. Okay. So that is the taxable amount which will come over here. And one last thing is 44B, which is for shipping business of non-resident. So if the ship is leaving India, then the entire income is taxable. Whether the money is received in India or outside India, it doesn't matter. But if the ship is leaving from outside India, then only that income will be taxable which is received in India. The money has to be received in India. So in this case, the goods shipped at the ports in India, this will be fully taxable. Whether money is received in India or outside India, this will be fully taxable because the goods are shipped from India. So that will be accrued in India. So this will be fully taxable. But if the goods are shipped from outside India, but then in that case only that much amount will be taxable which is received in India. The amount received outside India will not be taxable. So you have to take the first three things and you have to take 7.5% of that, and that will be your answer to question number 23.5. You can check it once. Okay. So let's move on to question number 24 now, which is based on multiple provisions of house property, chapter 6A, so on and so forth. Okay. So the first question is, what is the interest allowable to Mr. Sachdeva under section 24? Okay, let's try to find out the interest under section 24 for Mr. Sachdeva. So pay attention please, all of you. Now Mr. Sachdeva has taken a property on loan. He has taken a property of 4 crore on loan, and on that there is an interest of 40 lakhs, out of which he has paid interest of 37 lakhs. Okay. Now you should be knowing that under house property, under section 24, interest is allowed on accrual basis as well as due basis as well as payment basis. So it is allowed on due basis as well as payment basis. It is not necessary to make the payment to claim the deduction under house property. No. For municipal tax, it is necessary to make the payment, but for interest, it is not necessary to make the payment. It is allowed on due basis as well as payment basis. Therefore, entire 40 lakhs will be allowed as deduction to Mr. Sachdeva. Okay. So this is the first question. The second question they are asking, how much will be the chapter 6A deduction? So in chapter 6A, he has made multiple investments. First, he has bought some electric car. On that, he will get deduction under 80 EEB of 1.5 lakh interest. Okay. Then he has made some payment of loan for education loan for her daughter. Okay. And for that, he will get 50,000 deduction. Okay. Then he will get 80 deduction 20,000. And then he is also making principal repayment of loan. So he will get deduction of ATC 1.5 lakhs. So the total of all these four will come to 3.7 lakhs. That is 3,70,000 rupees. Okay. So this is the deduction that is going to get for what? Chapter 6A. Third is based on a case law of Delhi High Court, which we have done it in class 2010 case law. It is very old case law, CIT versus Asian Hotels, which says that suppose if I give my shop on let out to you and you give me a interest free deposit of 1 lakh rupees. Can government say that on that 1 lakh rupees we will charge notional interest and we will take tax on that? I have given my shop on let out to you. You have given me 1 lakh rupees. Can government say that 1 lakh rupees will be subject to what? Notional interest, and on that notional interest we can take tax? No. The case law has said that, Delhi High Court has said that it is not possible to do so. Okay. So this is what this question is all about. Okay. You can read that case law, that is there in our case law chapter, which is there in our book also, that is in our color book. Okay. You can go and check over there. Next one is Mr. Sachdeva's brother Ajay. Ajay is a non-resident and he is selling his house at BKC to another non-resident, Mr. David. So can Mr. David be called as an agent under section 163? Yes. In section 163, there is a provision which says that, in section 163, there is a special provision which says that if one NR sells his house to another NR in India, then the NR to whom which you are selling, that is the buyer, can be treated as agent. It is given in section 163, not very important. We have not done that in class. That is more relevant in paper 6C, but they have also asked over here once in paper 7. So with the help of this example, with the help of this MCQ, we are dealing that issue also. Okay. So 163 says that if one NR sells the house to or immobile property or any transfer of capital asset to another NR in India, that the other NR, that is the buyer, can be treated as agent. So this is what this particular question is all about. Question number 24.4. Now question number 24.5 is a controversial question whereby I feel the answer is wrong. Okay, I'll tell you the logic also why the answer is wrong. According to me, the answer should be Mrs. Sachdeva. Why? There is one daughter of Mr. Sachdeva and Mrs. Sachdeva, that is Raisha. Now, Mr. Sachdeva has transferred his property, that is, he has gifted his property to his daughter, that is Miss Raisha, and Miss Raisha has started earning income from that in April 2022. Okay, now pay attention please. Now Miss Raisha has started earning the income in the current year. Okay, now what happens in case of this? You have to club that rental income in the hands of the parent whose income is higher. Now whose income is higher? In the current year, Mrs. Sachdeva's income is higher. Okay, so you should club in the hands of Mr. Sachdeva, but institute has clubbed in the hands of Mr. Sachdev. You should club in the hands of Mrs. Sachdeva, sorry, in the hands of wife, in the hands of mother, but institute has clubbed in the hands of the father. Why? Institute has applied one logic which says that because in earlier year, Mr. Sachdeva's income was higher. Okay, so in the last year, Mr. Sachdeva's income was higher. Now there is a provision in the law which says that once the income is clubbed in the hands of either of the parents, you cannot change that in subsequent years. So there is a provision in the law. I am showing you that provision from the bare act. Once the income is clubbed in the hands of either of the parents, then you cannot change that in the subsequent year unless you go and take an opportunity, you go and take a permission from what? The assessing officer. But this logic is applicable only if the income is clubbed in either of the hands of the parents. So in the last year, if income was clubbed in the hands of Mr. Sachdeva, then in the current year you cannot change to Mrs. Sachdeva. Then you have to club in the hands of Mr. Sachdeva only. So you have to check whether the income in earlier year were also clubbed. If it was clubbed, then you cannot change. If it was not clubbed and this is the first year of clubbing, then it has to be clubbed in the hands of Mrs. Sachdeva. Now the question itself very clearly says that Miss Raisha does not have any other income in earlier year. Also, she does not have any other source of income of this year also. So Miss Raisha has not earned any income in the earlier year. This is the first year of Raisha. Therefore, this logic which is written over here that Mr. Sachdeva's income in the last year was higher does not work over here. That only work if clubbing was happened in the earlier year. If clubbing did not happen in the earlier year, then this logic cannot appear over here. It is written in the provision. I will show you the provision. This is section 64. You can see over here this point from and that is from the very first line which I am showing, and where any such income is once included in the total income of either parent. Is income included in any of the parent in the last year? No. Then this logic is not applicable, and any such income arising in succeeding year shall not be included in the total income of other parent. If income would have been included in the last year in the hands of father, then in the current year I cannot change it to mother, because the provision says that in that case you have to take an approval from what? From the assessing officer. You have to satisfy the assessing officer. But in the last year, the income was not there only in the hands of Raisha. This is the current year, is the first year. Therefore, this provision of logic which institute has applied to club in the hands of Mr. Sachdeva is illogical, is not relevant. Okay. So in my line, in my logic, the income should be clubbed in the hands of Mrs. Sachdeva and not in the hands of Mr. Sachdeva. You can check it once. Okay. Finally, we have come up with the last question, that is question number 25 of your scenario. Well, MCQ have already. Okay. Last question is a very simple question, nothing great as such. Of the question number 25.1, which of the following statement is correct in respect of a loan of 10 lakh obtained by Mr. Rajat from XYZ Private Limited? Now pay attention please. Mr. Rajat holds 20% equity shares in a closed company. Now you might be knowing that as per section, any shareholder holds 10% or more of the voting power of a closed company, and if that company gives a loan to the shareholder, then that is deemed. But the deemed dividend cannot exceed the accumulated. He is giving the loan, the company is giving the loan of 10 lakhs, but the accumulated reserves are only 8. It cannot be more than lakhs. Therefore, in this case, 8 lakhs would be deemed as what? Dividend in the hands of the first question. Now, the second question is, Rajat is withdrawing some cash from the bank. So, how much TDS will be deducted by the bank? Now, Rajat is regularly filing the return on time. Don't worry about it. Rajat is a regular filer of return. And if he is regular filer of return for all, the TDS above 1 crore deducted at the rate of 2%. Okay. So, now, Rajat is withdrawing how much? Rajat is withdrawing approximately 1.2 crore rupees over year. Okay. Rajat is withdrawing how much? Rajat is withdrawing 1.2 crore rupees over year. Can you see this? 1.2 crore rupees is withdrawn by Rajat. On this 1.2 crore rupees, the bank will deduct TDS at the rate of % on 20 lakh rupees on excess 1 crore. What about this 50 lakhs? This cooperative bank will not deduct TDS because in case the Rajat withdrawal does not exist. In case of this cooperative bank, not be deducted, but in case of this cooperative bank, TDS on 20 lakh rupees at the rate of 5%. Now, the next question is on Rahul. Rahul is not filing the return for the last 5 years. So now, if any customer who has not filed the return for the last 3 years, for him the threshold is above 20 lakhs up to 1, and above 1 crore it is 5%. Above 20 lakhs up to 1 crore it is 2%, and above about 1 crore it is 5%. Okay. In this case, the threshold for Rahul will be how much? Threshold for Rahul will be how much? It is 20 lakh to 1 crore, and Rahul is withdrawing how much? Rahul is withdrawing 50 lakh rupees. So for Rahul, the TDS will be 2% on 30 lakh rupees. Okay, because Rahul is withdrawing 50 lakh rupees, above 20 lakh rupees, the bank will deduct TDS at the rate of 2% for Rahul. Okay, so this is what question number 25.3 is all about. Now, the next question is we have to compute the total income of Rajat, assuming that he has not opted for 44, he is not opted for 115 BS. Now, for Rajat, what all income Rajat is earning? First of all, Rajat is earning profit of 60 lakhs. Okay, then Rajat is earning dividend of 12 lakhs from a company. Then Rajat is getting some birthday gift of jewelry from his friend. The friend is giving more than 50,000 rupees taxable, okay, as a IFOS. Then Rajat is also receiving deemed dividend of 8 lakh rupees. Okay, so these are the four income that Rajat is earning. But Rajat is also paying some interest on self-occupied property. So on self-occupied property, you get deduction up to 2 lakh rupees, right, of interest under section 20. So Rajat will get the deduction of this 2 lakh 50,000, out of which Rajat has paid 1 lakh 80. It doesn't matter. I have told you in the that in case of house property interest, it is allowed on accrual. So out of 2 lakh 50,000, if he has paid 1 lakh 80, he will get entire 2 lakh deduction. Okay. So this is how Rajat will compute his income: 6 plus 12 plus 8 plus 5 minus 2 lakh. Therefore, the net total income of Rajat will come to 83 lakh rupees. Okay. And the last question is the gross tax liability of Rajat. How will Rajat compute his tax liability on 83 lakhs? On first 10 lakhs, the tax liability will, you are not supposed to follow 115 BAC. Follow the normal provision. On first 10 lakhs, you are supposed to follow what? The 2.5 lakhs, then 5%, then 20%. It will come to 1 lakh 12,000. Then on next 73, that is above 10 lakhs, up to 83 lakhs, you will compute 30%. And then because the income is above 50 lakhs and up to 1 crore, 1 crore, will also apply surcharge of 10% and 4% cess. Okay, surcharge will also be applied over here. So if you apply all these things, you will get your answer as 26 lakhs 34,000. Okay, this is what the 25 MC scenarios is all about. And believe me, I have tried my best to give you the best of the knowledge that I could give. These MCQs not only also these 25 questions, there are around more 100 individually, assuming that every question 5 MCQ. In some MCQ there are 6 also, in 5 also. I have tried to cover around more concepts 5 MCQ. So I request you all to go of exam also, go through this once again. And I don't think so anybody has uploaded full English. A lot of lectures, but in English I don't think has up on particular thing. I'm trying my best for my South India. I don't want them to be felt apart from the North Indians. The number of services I try to give, I try my best to give all also. I will try my best. I'll try my best to keep all at par. I don't want to keep you as a leftover child. I don't want to keep as a cousin brother. You are my real brother, not my cousin brother. Okay, you are my real child, not my stepchild. I don't want to treat you all like a step. That is what my thinking is all about regarding your English. Okay. That's it from my side. I hope you all will do good and this video will help you all to a great extent. So please share this with all your for understanding English, and also make sure that you comment below that how you found. That will help to reach people across the country, and especially the of South India who wants to learn the entire direct tax in English. Last but not least, I hope that, I pray that all will do great. Exams will go like a butter. It will be a buttery attempt for you. Very, very simple for you. Don't worry. And last but not least, exams. Just make sure that you remember once, at least once. Just message once on my or my WhatsApp number or my Instagram, wherever. At least just that will be the. I don't want anything. I just want information that I have clear. Okay, that's it from my side. Take care, all of you. I will be coming up with some more videos. I'm not revealing what exactly that will be. I don't know whether I'll be able to do that or not. I'll try my best. If I'll be able to do that, that will help people to a great extent. What is that video? I'll reveal that in next.